Hello, Toby Bordelon. How are you, buddy?
Hey, good, Jason. How are you today?
I'm very good. And to all the Motley Fool members out there watching, welcome. Glad you're here. And to all of those that are now joining us on YouTube as well, we're going onto the YouTube stream as well. Welcome to the Motley Fool's Fool24 live stream chat. We do Q&A. We answer lots of questions. We have a theme for each hour as well. First of all, if this is your first time watching and you'd like to ask us a question, please get that question to us. Go to slido.com, slido.com. The event code is Fool24, all one word. That's the code. Put that in. Get your questions into us. A couple of important things to note. First of all, we are not here to provide individual or personalized investing advice. We don't know you. We don't know your situation. We're just a couple of dudes on the internet. We know a lot of stuff. We have a lot of experience and investors and expertise, but this is not a forum or a format to receive individual investing advice. We are not providing that. So just please keep that in mind. Also, we have a theme for every hour as well. And the theme for this hour, Toby, is news versus noise.
It's a good theme. It's a good theme.
Right? It's a good theme. Yeah. Should I explain it?
Yeah, what are we talking about, Jason?
Okay. So news versus noise. Here's the thing. There's lots of news that we see out there every day. Today, a big one, the jobs report. We're coming through earnings season where we're inundated with lots of data and information about companies. And a lot of that is just noise. So I want to break that down, and we're going to have some examples and talk through. And as we're answering questions from members and folks on YouTube that aren't Motley Fool members yet, we like to think of those people as maybe future Motley Fool members. Separating out what's actionable and useful from all of the inundation of information that we get that's just more noise. Finding the signal, something that tells us something that we can use in some thoughtful way to improve our investing returns, avoid future losses, and just do better, smarter, happier, richer, right? To focus on the Motley Fool's 3 goals. Toby, I'll use the news today, the biggest thing, the biggest macro thing, and that's the jobs report. So U.S. added estimates. And of course, this is the initial estimate. This is going to get revised multiple times. 151,000 jobs. That was a little below expectations, but it was within shouting distance of it enough so that if you look at the market today, that's what we always do. We look at this noise, and we look at the market and say, okay, how am I supposed to think about it? Sometimes that's what we think is like, what's the market doing? And then that should inform how I think about it. We have another day where the market is down. Now, my question for you, Toby, again, news, this is a signal, this is actionable. There's something I can do with this information to inform the decisions that I make as an investor. And it's not binary necessarily, it's news or noise, but maybe thinking about it on a 1, it's noise. On a 10, it's absolutely actionable. Somewhere in between. What do you think about something like the jobs report? Where does it fall for you?
Well, I mean, it depends on what it actually is, what the numbers are, right? But given
whether or not you're directly one of the numbers that's inside that.
Well, sure.
It's very actionable if you lost your job or you
that,
added a job,
that's a problem,
right?
No, but when I see a report like this, right, I mean, we're close to what the estimates for, and there's, it's still going up, right? We're still adding jobs, and employment ticked up a little bit, right? 4.1% versus 4%. I look at this report, Jason, and I say this is probably about a 5 or 6 for me, in that it doesn't really change anything. It maybe gives me a little bit of a comfort, and the comfort comes from from the fact that it doesn't look like this is a report that suggests inflation is going up massively again, which maybe gives you some
in such a way that it upends what companies are doing around hiring.
Let's raise our rates, right?
Right.
I think that looks like if you were concerned about that, okay, I don't think you're concerned about that right now. Does it make it more likely Fed's going to lower rates? I don't know that it does, but maybe we're getting closer to that point. As we look down the road a little bit, maybe it suggests to you that 1 quarter point rate cut might be on the table this year.
Right.
If we continue like this. I don't think it was a bad report, right? It looks like, okay.
I agree with that. I agree with that. Right. Again, for me, honing in on what can I do with this as an investor? What can I do with it? For me, like in terms of the value of the information in terms of like mindset and thinking about like directionally where are things with the economy broadly. Yeah, I think 5 makes sense, but directionally as an individual investor, I would move it down to like a 3
Hmm.
or even a 2 because I can't take this and go out there and apply it in some way that's going to be meaningful and important. And this matters because I think a lot of investors, Toby, you and I are on Fool24 a lot. You know, we're on here multiple hours a day. And I would say if there's one common thread we could pull from the questions that we're getting that are the most commonly asked, there's something around the idea of what's going to happen with my stocks in the next couple of years, right? Those near term things. And a lot of times something like the jobs report, inflation data, those macro things, they give us the impression of being actionable, but there's not really any way to put those things into use in a way that's going to, with any level of predictability, improve or worsen your results in the near term. You know what I
I think
mean?
that's probably right. I would say that look, if you, uh, the one actionable thing I might take away from this job reports involves digging into the numbers a little bit, right? Beyond the headline numbers and look at where are these
Exactly.
job changes coming from. And you
Right.
do see something interesting when you look at that, Jason. You see the biggest, the sector that added the most jobs, and this is in February, right? 1 month change. So a month is a month. I don't know how much you want to take that uh, in terms of a long-term perspective, but healthcare and social assistance and the Bureau of Labor Statistics put these together, right? That added a little over 63,000 jobs, right? So of the 100 and what are we, 151, a little less than half was in healthcare and social assistance. So that's a signal, maybe, right, to say, okay, this part of the economy is adding a lot. That's a lot of jobs, right?
Yeah.
And it's by far like the second biggest adder in terms of sectors was financial activities. That was 21,000. So you've got a 3x with healthcare and social assistance over the number 2 in terms of additions. Maybe that says something, right? At least that tells me, okay, if I'm looking for opportunities, how about looking at healthcare? Because it seems like they're hiring a lot of people. There must be something going on there, right? The
Yep.
flip side of that is the industry that lost the most, um, leisure and hospitality, lost 16,000.
That sits
So
right in the middle of discretionary spending.
exactly, there's a
Yeah.
discretionary, very, very discretionary. Also, a sector that has boomed over the last couple of years, probably boomed longer than many of us would have
Right.
expected it to
The
do so.
pin up demand for
Exactly.
experiential things. Yeah.
And yeah, and you look at that and say, well, is this a sign of maybe a pullback in the sector? Of course, then you realize we're in February and you realize that there's a lot of seasonal workers in the holiday season in leisure and hospitality, and you start to wonder, I maybe it's actually just some seasonality rolling off here as we're coming off of the winter holidays, getting ready for the summer travel season. I don't know how much that means. It's 16,000 in the whole industry. Do I really think that's a big deal? I maybe think about it and I look at that sector as saying, okay, I need more information. I'm going to follow earnings reports very carefully over the next quarter and that. Let's see what happens in the summer, right? If I start to see signs early on that maybe summer ain't going to be what we think it's going to be in terms of everyone spending money again, there are some concerns there. But I think that the biggest takeaway for me might be look at healthcare and say, okay, that looks promising, that sector.
Yeah. And one of the things that I do in these sorts of environments, Toby, is I look for cyclical businesses where the long-term secular tailwinds are very good and try to find opportunities too.
Yeah,
We've seen
yeah.
a lot of tech has come down. Everything uh, tied to AI broadly, where AI is kind of the a major leg on the stool of its growth opportunity, um, have all been hit pretty hard. Uh, a lot of stocks that went up post-election have given up a lot of those gains because of a lot of economic uncertainty, that the benefits of things like the pro-business administration, potentially getting lower corporate tax rates, some of those other benefits, doing things to strengthen U.S.-based businesses. There's a lot of uncertainty around those things. So when investors are looking at a market that's still relatively expensive, even though it's come down, and I'm thinking about finding opportunity and uncertainty, I usually look at those markets. So, for example, I've talked before about some companies that have done a wonderful job of winning in their industry, but the stocks are down more recently, that I think are really interesting, like Enphase. First Solar is another one that's really interesting to me right now. First Solar is one of the few stocks in the solar industry that's generated positive returns over the past 5 years. Residential solar is a mess. First Solar is entirely a utility scale business and has a massive backlog of business. The stock looks pretty reasonable. And then Enphase, its business is almost entirely residential. That business is in the midst of the biggest downturn in a decade for residential solar by far. But the company's been able to generate free cash flow every single quarter during the downturn, which is remarkable for a company that manufactures a product. And it's started to take some market share in recent quarters as well from competitors like SolarEdge, because they've had the money to be able to be aggressive, and they've built the best ecosystem. If you think about, as a residential solar owner, there's a good chance you have no idea who makes the panels on your roof, but you probably know SolarEdge or Enphase because the microinverters, the inverter that you deal with, it's their app that you're using to monitor your system, right? If you have batteries, again, you go through their app to deal with, see if your batteries, are charged, or if there's a weather alert or something and you need to change the settings. You're going to know those companies in their ecosystem, and Enphase has built the best ecosystem in that I think gives it somewhat of a moat, which is interesting for that kind of business. So I'm looking in places like that, thinking a little bit counter-cyclical, instead of just trying to maybe find blue chips that can be safe through these environments because they're all so expensive. You look at the safety stocks and they're all trade for really high valuations. So that's, how I'm thinking about, again, trying to find somewhere where I have some level of certainty in the near term and the long term, particularly the long term with stocks, and not getting too caught up in trying to how to defense my portfolio in the near term.
Yeah, Enphase is up almost 18% this week, Jason. This week.
Yeah. Yeah. It's down about 75% from the high, though. So
yeah, that's fair. But let's think short term here.
I love it.
No, and up today in a bad market today. So that's interesting. But yeah, it is. Right. It's down quite a bit from its high.
Do we want to take Glenn's question?
Let's take some question. But first, let's do that. But first, let me throw this out to you. Signal or noise, Jason? Breaking news here from CNBC. The Dow is headed for its worst week in nearly 2 years. Do you care about that? Worse in whatever time frame, but especially a 2-year time frame. Is that noise or a signal here?
So I think that it has happened is noise, right?
That's probably right.
The underlying why might be signally in terms of, as an investor, again, looking for opportunity. I don't think it's signal. I don't think it's actionable in telling you what to do to avoid. I think what happens a lot of times with these sorts of things is an investor reads the headline and maybe they have a Dow ETF, right? Because they've seen the Dow hasn't done as well as the S&P and the QQQ, the NASDAQ 100 over the past couple of years. And they're like, you know what? I'm going to buy some of this Dow because I think it's going to do well. If these other indexes, or these high tech indexes, are probably going to give back some gains, maybe not do as well, I'm going to bottom feed and I'm going to buy some Dow. And they do that strategy, and then they see that the Dow's down and they're like, okay, I'm just going to sell, right? Without actually trying to understand the fundamental cause of the thing that's sending the Dow down, right? So you need to look at how many companies are in the Dow? Less than 2 dozen. It's not that many. Did we see a couple of earnings reports that underwhelmed and some guidance that concerned investors? Is that's what's sending the Dow down? I'm just throwing things out there. You got to find something in there that's actually meaningful before you act on these things, is the way that I think about it.
Yeah.
You know?
Yeah, seems right. All right, let's address Glenn's question now. Is it time to sell Tesla, Jason?
It just depends. Not for me because I don't own any, so that was easy.
Fair.
Yeah. So no, I'm sorry,
I don't.
Glenn.
This is not one that I own either. Look, Glenn, it's a good question, right? Let me see where we are on.
We have to talk. We don't have to, but I think Tesla is interesting because if we think over the longer term since Tesla was founded, it's done something astounding. It's done something no other country or company had done before it in many decades. And that was to start up a brand new car company and actually succeed. Like just succeed, just actually make it. Much less become the most valuable auto company in the world, much less become the leading, like one of the things that a lot of people don't know is that the Model S for a significant period of time was outselling every single luxury sedan in the world. It's outselling the Mercedes, the BMWs of the world. That's a big deal, right? Just to be able to do that. And also is one of the two largest electric vehicle manufacturers by volume on earth. That's absolutely incredible. A big part of Tesla, though, has always been the story of what's next. So you have renewable energy with the solar business hasn't done well. The battery business, which has been incredibly successful and continues to grow, not just residential batteries, but like their utility scale battery, has done incredibly well. And then the next story, Toby, artificial intelligence, automation with robotics. They're saying next year 2026, they're going to launch a fully autonomous vehicle. We've seen the autonomous vehicle can get kicked down the curb a lot, right, over the past 4 or 5 years. So, but Tesla's always been late on its goals, but has always had wildly aggressive goals for products and things that they brought to market. So, I think if you own Tesla today, again, the stock's lost, I don't know, half of its value, roughly.
It's down. So here's the interesting thing, Jason. It's down a little over 33% in the past month, right? So that's a lot in a month for any stock to see its price get cut. But
it's
it is down also
47% from the high in December,
right? And it's also up 42% over the past 12 months.
Yeah. So there's a lot of ways to look at is it up? Is it down? Is it up? Is it down? But I think my point is that if you own Tesla today and you want to continue to own Tesla, you're not owning it to be an automaker. You're owning it to be an automaker and the other initiatives that are there, that the idea is those things will create free cash flow, economic value, at much larger scale than the auto business is. I followed the auto business for 15 years, Toby. It's a terrible business. It's not a great business over the long term. These other things have to create value, and you're buying it and you're holding it for those things, right?
Yeah, and you're holding it without any certain. Well, that's true with any company, but I think especially here, like given what we've seen so far, I don't think there's a high degree of certainty that any of this is going to work out necessarily. Right?
Yeah, but you 15 years ago, you'd say the exact same thing about the car business, right? So
yeah, you probably would.
The credibility is Elon Musk led this company to do something. Even the legacy automakers couldn't come close to doing until Tesla showed the entire world the way to do it.
Yeah.
With commodity batteries, lots of them, scaling that up and selling great, fast, sexy, fun cars instead of cars that are sipping electrons and slow and cheap. Let's build something fun. Let's make it expensive. And then we can make money. We don't have to sell a bunch of it. We can make money. And then we can use that money to scale up and do other things. So That's
I
the thesis. I think
I will
selling.
say,
Go ahead.
yeah,
Go ahead. Toby.
no, I will say this on Tesla. The what I have seen in both the movement of the stock and the performance of the business over the last couple of months would not change my views on the company long term, either
Yeah.
way, right? And for me, um, look, I was flat out. I thought the company may have been a little overvalued a couple months ago,
I thought it
a
was
year ago.
overvalued for 10 years, Toby.
I
That's
still do. I still believe that even after this drop, right?
yeah.
I just can't get my head around like giving this much value to the potential of what we see in this company, and people disagree with that, and that's totally fine. That's why the stock is where it is, right?
Right.
But I don't look at what I've seen over the last few months here that would change, I think, an opinion in either direction. I just don't think
I,
you've seen
I
anything to change your mind.
I'll go so far as to say if a couple of these other initiatives do deliver, this is a $2 to $3 trillion business. I will
Could
say
be.
that. I will say
Absolutely.
that. But
Absolutely.
again, to your point, whether that happens or not, I think the bigger answer to the question, though, that that was being asked is it time to sell Tesla? That's a different question. Okay.
Yeah.
And I think part of the answer is if your belief in that thesis, your expectation that Tesla can deliver on those things is affected, you don't have the conviction that it can, then maybe the decision to move on makes sense. But the bigger question that I think more investors should be considering is investors that have owned Tesla for more than a year, more than 2 years, more than 5, that have ridden it to, 15 bagger returns, 20 bagger returns.
Hmm.
I think those investors, I'm actually just taking a look at it right now. Over the past 10 years, Tesla stock, even down by almost half, it's still 1900, it's still a 20 bagger over the past 10 years. If you've owned it for longer than that, we're talking, a 100 bagger, right? I mean, it's just been an incredible value creator for a lot of people. And
Yeah.
I think the bigger question that a lot of investors that own this stock should consider is if Tesla is a stock that has come to represent a significant portion of your net worth. Now, if you're 30 or 35 and your net worth is relatively small, that's a very different conversation than somebody that's 50 or 60 or, in retirement, where your net worth is the thing that is ideally you can continue to grow it. But if something is 10 or 15 or 20% of your net worth and that losing significant value could undermine your ability to live the life that you want, maybe it does make sense to sell some to avoid permanent injury to your ability to live within the means that you want to. We invest to reach our financial goals in the real world. It's easy to fall in love with businesses that have done really well for us and forget and detach that from the and forget about why we actually own them. And we own them for the value that they can create in actual wealth. They can fund our life, right? They can fund our life. And the biggest mistake a lot of investors make, we talk about selling too early and missing out on upside. The second biggest mistake, and sometimes the biggest, depending, is holding too long and letting downside creep up and snatch wealth away from you that you could use to improve the quality of your life. So I think investors that have done really well on Tesla, and it represents a large portion of their net worth, and they don't necessarily have years of new contributions and market returns to offset that loss, should be mindful of that risk. That's all I've got to say. And you can pull Tesla out and insert any stock in that same
Yeah.
conversation, right?
Right. And I think, look, we'll kind of close the book here on Tesla now, but I I think if you're going to be an owner and investor in Tesla right here, I think you have to view it as a high risk startup at this point, given where what the market is pricing it for, and do not look at it as a mature company that has been successful in the automotive business, because that's not what you're buying, right? in terms of future growth. You're buying the AI, you're buying the robotics, right? And you've got to look at it as a high-risk tech startup. Think about it that way and size your position accordingly with that framework in mind, I think, if you're going to be an investor in the company here. Do you want to
Yeah, I
talk
think
about
that's fair.
tariffs?
Say it again?
Do you want to talk about tariffs?
Not really. Been talking about tariffs all week. I'd love to
We
talk
do.
about tariffs.
Let's
I'd
talk about
love to
tariffs.
talk about tariffs.
Peter has two questions on tariffs. One, is tariffs affecting the stock market negatively, news or noise? That's the key question here, right? What are all the news about tariffs? Is this real news we can use? Is this noise? And his other question is, it's similar. How is tariffs affecting the stock market? Will AWM be able to climb back up to its highs? Let's talk about the tariffs part here.
Yeah.
Is this news, Jason? What we've seen this week and prior on tariffs, is this news that impacts your investing that investors need to think about?
So again, trying to quantify this in terms of, is it something that I can use in a meaningful way to improve my outcomes? I think it's largely noise. But it's useful because thinking that through can help empower us as investors to do the hardest thing, which is to get through these periods of volatility and not mess up a good thing and not make mistakes that are going to harm our ability to generate great long-term returns. The hardest thing to do as investors is get through periods of volatility without monkeying with our portfolio because we feel the drive to do something. The kind of person that is interested in buying individual stocks is an action-oriented person almost every time. And we're going to be driven, like we feel like we need to take control and do something. And what we do know is that, and David Gardner, Motley Fool co-founder, has talked a significant amount about this. David's got a new book coming out this fall, by the way. I encourage people to check that out. When the market goes down, it goes down fast, right? Downturns happen quick. It's the analogy of, somebody screaming fire in a crowded room. People fight for the exits and run to get out quickly. But the market goes up more often. And we've seen it goes up a lot more over the long term. Something like, 3 out of every 4 market days, 7 out of 10 for sure. Historically, the market has gone up. And roughly it's that same number of years the market has gone up. And it's a very rare decade where stocks lose value. The point of that is when we're trying to react to these sorts of things to avoid downturns, typically by selling, I'm like, you know what? This is a top. I'm going to take some money off the table and I'm going to wait until the bottom. And then I'm going to buy back in. And then inexorably, we see more of those up days than down days from the time that we made that decision. But then we anchor on where we sold. It's like, it's going to come back down. I know it's going to come back down. And then you sacrifice weeks, turns into months, turns into years. And you've had a significant portion of your wealth sitting on the sidelines. And the opportunity cost has happened, and you will never get that opportunity to compound back again. So I would say that it is a combination of news, because we do know that in our real lives, if tariffs stay in place for a protracted period of time, stuff's going to cost more. People that work in industries, restaurant industry, auto industry, discretionary spending stuff. You talked about the service industry broadly. Those people are potentially more at risk of lower income, more job losses, that sort of thing. So there's real world implications there. But as investors, realizing that this is just part of the market cycle and it's going to happen, we don't know how it's going to affect the market. We don't know how long it's going to last. We don't know what the outcomes are going to be. I think that's things that we can use. The actionable part of that, Toby, is accepting that it's the market that we're in and we have to invest in the market that we're in, and that our returns, our wealth that we get from stocks is bolstered when we just have the ability to hold through these periods and get to the other side, and we get the benefit of holding great businesses that grow and generate value and become more valuable 3 plus, 5 plus, 10 plus years, that's where the real wealth gets created. And if we react to every single piece of noise out there that's in the news to try to time our way in and out of the market, we're never going to hold through to the good times. A piece of data that I shared a couple weeks ago, maybe it was earlier this week, I honestly don't remember at this point, but it was so telling. The first week of October 2007, do you know what was special about the first week of October 2007?
I do not. What was that?
That was the market peak before the Great Recession, the global financial crisis. 18 months later, roughly, 15 months later, March, like the second or third week of March in 2009, was the bottom. The S&P 500 and the Dow were both down like 55%. And it wouldn't be until 2012, 5.5 years later, 2012, from that October peak to the market recovered and stayed above that prior period. So holding through all of that period is really difficult. But here's what's magical about time and returns. If you had bought what was arguably the worst time to have bought in the better part of a decade, that first week of October 2007, and you held till now, you'd be up 420% roughly.
Yeah.
About 10% a year on average, roughly the market's long-term averages from the worst time to buy in a 5.5 year period, right? So time is amazing and it is your friend. You have to build a portfolio, position size against risky investments like the Teslas of the world, asset allocation based on your real world financial needs. You know, a 35-year-old needs a lot less cash than or bonds, that predictable, stable stuff, than a 70-year-old does. That needs to be predictably having assets to pay their bills in the near term. So that asset allocation is a big part of the conversation. And building asset allocation can help you get through these periods without feeling like you have to act.
Yeah.
All right, what's next, Toby?
Well, Zach the Fool's got a couple of comments which are interesting here. He says, resisting the impulse to do something. I'll first say I'm 100% a net buyer of stocks. I strive to minimize selling, especially in a downturn. That's great. However, over time, I've noticed downturns sometimes help me recognize where I do and do not have true conviction. This can be true.
Yes.
And this is a good benefit of downturns. They do make you focus on a little bit more on the companies that you do truly think are quality businesses for the long term, and not just because they go down, right? But I think that act of seeing a stock go down, Jason, makes you take a closer long-term look at it, just inherently, and say, where do I see this business in 5 years? And if the answer is I have no idea, then that indicates maybe you don't have a lot of conviction, right? Maybe it's something you thought was fun. And there's nothing wrong with investing is because, hey, it's a fun company. It might do something.
But it's easy to have conviction when it's going up, right?
It is, right?
Yeah.
But then, it goes down. You think, you know what? It was a fun company. Maybe it'll do something, but probably not. This other company over here that also has gone down. I look at this and, well, you know what? I can actually see what they're going to do long-term, what their plan is. I can see this business being something bigger than it is. So yeah, it's good to see those things sometimes. Downturns.
Yeah, Zach, this is very timely. Toby, I sent you and the production team a list of stocks that I can't talk about because of some actions I did yesterday, mostly selling covered calls, but I did pull a few weeds. I'm notoriously glacial about selling. I will own and hold losers for multiple years, and give the people running the business time before I make a decision. Usually it's really small positions that I haven't added to because the business hasn't deserved any more of my capital. But I did, for exactly the reason that Zach's talking about, thinking about the environment that we're in. The market has come down. Some of these stocks have fallen more, and long term, the stocks have been losers for me, but the businesses also just really haven't delivered on the thesis. So I did do a little bit of pulling of weeds, which gave me a little bit of extra cash in my portfolio. Not much, a couple percent, 1.5% or so between the ones that I sold, but it's a little more cash that I can be timely about. And to Zach's Fool's point, where I find that my conviction is strong, and if I see opportunity to add to those positions, buy a little bit more.
Yeah.
Let's see.
Do you have any thoughts on the trade desk? There's a question directed at you on that one from Finn.
Finn, I do. So Finn's question, could you talk a little bit about more if you think the trade desk thesis has changed and how their technology may become obsolete? So I'm going to start at the end of this question and work backwards. I don't think the trade desk is at risk of obsolescence. It is still the dominant platform on the buy side for the biggest ad buyers in the world that are looking to leverage data to inform their advertising in the programmatic advertising space for digital advertising. They're just really, really dominant. The biggest agencies rely heavily on the trade desk as a partner. So I think the risk of it becoming obsolete over time is if they fail to continue to innovate and leverage AI. And I don't think that's going to happen. Jeff Green has been in this business for 25 years. He's one of the thought leaders and also kind of the creators of the whole idea of digital advertising and programmatic advertising. So I have a lot of faith in him. One thing I have mentioned before, and I don't know how much truth there is to it, but this is it's a little bit of a thing that's kind of stuck in the back of my head. Dave Pickles, the co-founder of the trade desk, left the business a little over a year ago. I think it was maybe the fall of 2023 when he left the business. He was the chief technology officer for a long time. And I think he stayed on as an advisor. I think he's still an advisor to the business, but I just do have some questions about when he transitioned away from the business, if there was a little bit of a loss of focus on the execution side there. The results this quarter were okay. They missed their own guidance, which they've only done like one or two other times before.
Yeah.
I think ever as a public company. But what we do know is that their future guidance, their forward guidance for this year was far below expectations. And that probably played the biggest role in undermining the results. To me, it says a tremendous amount about the credibility of the leadership there with Green, that they didn't just throw out a guidance number to keep the market happy. I promise you, they knew when they missed and put out weaker than expected guidance that the stock was going to get hit. They knew this was going to happen, but it's a tremendous amount of integrity and leadership to do that. And then lay out a plan in public to lay bare. These are the things that we need to do better. So I don't know that the thesis has necessarily changed. I think the expectations have changed is maybe a better way to think about it. And what I'm doing now is I'm back to, this is a stock that I've owned for a long time that's done really well for me, Toby, that I've been reticent to buy more of over the past year or so, because there's this expectation that this business can't do any wrong, can only continue to grow, take share, be the leader, do more, not make any mistakes, get it perfect every time. And the valuation, to a certain extent, they earned a premium valuation because they always over-delivered. They always did better. They were right around where their guidance was. And the market was very happy with that performance. But the market's expectations have come back down to earth, I think. And I think that's generally healthy. because I do have a pretty substantial exposure, and because I do think that there are questions that we need to get a little better answer to and clarity in the next couple of quarters as a starting point, I decided to take a little bit lower risk way to add to my position this time, selling some puts that are deeply in the money. That if they correct those problems, I'm just going to earn the premium from selling the put because the stock's going to stay well above the strike price, which is the price that the person on the other end of that option could make me buy the stock for. The risk I'm taking on is if the stock's down that much, then we may see some obsolescence. We may see some undermining of the moat that the business has built. And I could be buying a business that's problematic. But the way that I've structured it, I would be still buying it at a substantially lower price than today's market price, which I think the stock is far more likely to be above in a year or two from now. Just because I do think this is still one of the best quality businesses in the world. Okay.
Yeah, I think I agree with that.
Okay. What else here?
Let's see here. We got several. Kind of depends on what you want to talk about.
Let's see here. Let's say Vihan's kind of given us a kind of a cornucopia of stocks here. Has some question about in terms of our thoughts for valuation, and we're thinking about them. I'm going to do something a little different. I'm going to, instead of answering Vihan's direct question, I'm going to answer the version of it that I want to answer. So specifically, Vihan says, gentlemen, well, one of the two of us is a gentleman, KKR, Alphabet, ticker GOOG and GOOGL, Airbnb, which is ABNB, Disney, which is DIS, Shopify, SHOP, Amazon, ticker AMZN. Specifically, I think Vihan is looking for, thinking about with the sell-off across these stocks, thinking about current valuations, where we might consider adding if we own or initiating a position on. I will tell you this, the ones of this group, there's only a few that personally I'm really compelled by right now that I think are interesting. I think Shopify, as well as the stock has done over the past year and a half or two, just recovering and getting to what on paper might look like it's gotten a little bit expensive. I think if you think about the opportunity for commerce broadly and the quality of a business that they've built, as sticky as it is, and the switching costs, and how people that are using it, merchants that are using it, will be so unlikely to change, because it's a little bit like CrowdStrike, where they keep adding more and more things to it that make it more powerful and sticky. I would put Shopify on that list, and I would put Alphabet on that list. I do think Alphabet's gotten, I don't want to say cheap, but it trades for 17 or 18 times expected earnings for its next 12 months, which I think for a business that can probably continue to grow its earnings per share 15% a year, maybe even better in the coming 5 to 10 years, I think that's a good price. I think the concerns about artificial intelligence undermining search might be a little overdone. So I think a lot of those concerns are from very tech-focused people that are expecting a lot more adoption of AI for a lot more people that may not necessarily be ponying up to buy ChatGPT and asking it questions when they can use Google search. So I don't think that that's undermined a lot, especially when you bolt on something like YouTube, which is darn near as big as Netflix, right? So that's a pretty good business that Alphabet has too. So those are the two that are the most compelling to me. Disney, I still want to see them answer some more questions. I mean, the stock could be cheap, but we still don't know who the long-term CEO is going to be. They're still dealing with a decline in their linear TV business. They've gutted ESPN in terms of a lot of the cost. But I haven't yet seen the inflection point with that part of the business, with their entertainment business, and clarity on their long-term leadership position, where I'm ready to spend a dime on Disney stock. What about you? You got some thoughts on some of these? I think you might have a little bit different opinion on Disney than me.
I do. I
Yeah.
look at this list, Vihan. I'm actually I would be fine buying every single one of these companies as a long-term hold. I think they're all solid businesses, quite
Yeah.
frankly.
I would, I would not argue that at all. I would not argue that at all.
Yeah.
Yeah.
So, I mean, if anyone wants to look at these and say, yeah, um, let's put these in my portfolio right now. Sure, I would do that. Absolutely. And I own, let's see, either I or my kids in some variation own all of these except KKR, I believe. Just off the top of my head.
Yeah.
Yeah. It's
I don't own KKR. I follow it, but I don't own it.
right.
Yeah.
Same with me here. Disney, I like Disney long term. I think I do want to see who the new CEO is going to be. I have confidence, maybe it's misplaced, that the board is not going to get it wrong next time around. In part because I don't think Iger can do a third comeback. I think that's just not going to happen.
No.
The concern I have about Disney is if you look for some concerns, right? The linear TV thing I could take or leave because I think that's on its way out regardless, and I think they've done a decent job of preparing for that in terms of making streaming profitable.
Exactly right. That's exactly right.
Leaning into Hulu and as a mechanism by which they can still do live programming via ABC, combining Hulu with Fubo TV to kind of have that there. ESPN, I think they needed to look at costs a little bit. And then they went and gave Stephen A. Smith $100 million. So there's that. But I expect that they're taking that over the top for sure.
Absolutely.
Imminently, right? I think they've pretty much flat out said that.
As soon as they can, right? As soon as they can.
Right.
Yeah.
And they're focused on making it not just we have the sports content, right? But also making it entertainment. And what did they do? They signed that licensing deal with Warner Brothers to get the TNT studio crew next year because they knew that look, this is a very highly rated show. If we're going to have an NBA product we're putting out there, we want it to be we want to draw people in and have them watch our version of that. How do we do that? Get the best crew out there, the one that everyone wants to watch. There you go, right? So I think they're doing a nice job of combining sports plus the Disney entertainment brand. With that, we'll see how that all works out. My concern, Jason, is more on the theme park side. They've done so well coming out of COVID, but there is a massive amount of capex in that part of the business that they're spending a lot there, and they look like they may be hitting the limits of consumer willingness to stomach price increases. You're starting to see some pushback. You're starting to see even Disney executives say, well, we do need to focus a little bit on value here and delivering a good value to our customer. So we might be kind of, at least temporarily, at the point where they can't rely on raising ticket prices or that sort of stuff to kind of fund that capex. So maybe we see it pull back a little bit. I don't know. It's very expensive to keep producing the next big ride that makes you say, I need to go to Disney World this year, right? These aren't cheap. And just the maintenance of this stuff is not cheap. And then with the cruise business, which, the cruise industry has been great in general, right? Last couple of years, they've got I think they've announced 5 more ships that don't have that are beyond the ones that are entering service this year. Really a big expansion for them in their fleet. Now it's a small part of the business, right, overall, but this is also a capital intensive business, which is susceptible to that consumer dollar, right?
Right.
In an economic downturn, am I going to cancel Disney Plus? Probably not. Am I going to not go on a cruise or not go to Disney World? I can easily do that. I can push that out a year.
With that said, Disney Plus has had much higher churn than Netflix, much higher churn. So it's going to be interesting to see if with their streaming product as a whole, looking beyond just Disney Plus, if they can become a little bit stickier.
Yeah, with that, I think that's part of the idea of leaning into sports a little bit more.
Yeah.
Uh,
That's what makes that's what's
right.
live
It
sports is
makes
what
it
makes streaming
sticky.
sticky.
It makes it
Yep. That's
sticky,
exactly right.
especially if you have
Exactly.
that bundle, right? If you can convince someone, look, what I really want to do is pay for ESPN uh, and some of these live services here. And if you're telling me that Disney Plus, which might ordinarily cost me $10 a month, cost me an extra five, all right. I can stick with the whole bundle, right?
Yeah.
So that's really the secret, I think, for them. They have a very compelling overall bundled product they can offer a lot of different people.
Right.
Um, yeah. So yeah,
So
I like it. But there are risks. It is a consumer-driven business. You can't get around that. And it
Air
is one that there is no way they don't take a hit if we see a major downturn in consumer spending.
Yeah, no, absolutely. And I think to a certain extent, it's the same thing with Airbnb. I think there's a little
Yeah.
bit of risk there.
Yeah.
But with that said, I will say, at about 19 times free cash flow, Airbnb's I'd put it in that same bucket with Alphabet. And that's a reasonable price to
I think
pay
so. Yeah.
if over the long term they can continue to grow free cash flow per share 12 to 15% a year. Then that price is going to work out. What's going to happen? I don't know. We don't know what's going to happen this year, right? We spent half the show talking about it's impossible with any accuracy to say what's going to happen based on all the macro noise. Whether it disrupts their business models, but again, you stretch it out over the long term, I think we're fine. I'm going to take Matt's question that he directed to you, Toby, about McDonald's just really quickly.
All right.
So he was just the short version is Matt was asking if the PE that we saw a couple weeks ago was around 26 times was too much to pay, and now it's 28 times, about an 8% increase. Is that enough to make us bearish at the stock's current valuation? I think what you have to remember is that McDonald's is a little bit of a counter-cyclical with
Yeah, I
investors.
think that's
They're
what's going on
looking
here.
right,
Yeah.
right. So while so much tech, AI related things are down, and plenty of other restaurant stocks too. And you look across retail, the Best Buys of the world, Targets of the world that have taken it on the nose, taken it on the chin. McDonald's is kind of the Walmart of the fast food business, and that they have a lot of low cost items, and they're gonna not necessarily win, but they're gonna lose less, right? They're gonna hold up better through these types of environments. And so investors are moving to where it's safe. I think part of it too is it's also a little bit like Walmart, where maybe investors have certain assumptions about how it makes money and where its money is that don't necessarily line up. Walmart it's the economic strata of its customers has moved up the economic scale in recent years as their e-commerce business has gotten stronger, as the quality of their grocery business has improved. Walmart is attracting people across the economic strata. So what's better than just having people on the lower income echelon continue to shop at your store? Having people with disposable income that are buying higher margin items continue to go there. What's different about McDonald's is the fact that a lot of its business is built on real estate and the licensing of its franchise business. It doesn't operate as many of the restaurants as you would think. And that licensing income and the income that it earns from owning the real estate a lot of its franchisees sit on is a lot less impacted when consumers have less to spend. That part of its business holds up really well. So there's more to the story. But I do think McDonald's, if you're buying it at these prices, you have to hold longer to get acceptable rates of return. Valuation is so important for a business like McDonald's when you don't have the margin of safety that's really hold it long enough. And if it's a good enough business that can grow into that valuation, you can get above average returns.
Yeah.
All right. What's next?
You want to prognosticate, Jason?
I'm always happy to
Thoughts
prognosticate.
on Berkshire buying Brookfield? From Quill 3 minutes ago.
Zero.
Should Berkshire buy Brookfield, or should Berkshire buy Brookfield?
It won't
Well,
happen.
that's a different question, I guess.
Yeah.
Zero it happening, right? Not going to happen.
Yeah.
Why wouldn't it happen?
A lot of reasons. Number one, I don't know that the investors at Brookfield would have any reason to want to see that happen. It's
That's
just
fair.
as a starting point. Brookfield and the subsidiaries, their ability to compound and outperform the market over the long term is substantially higher than Berkshire's at this point. At this point, Berkshire is a ballast investment that over the long term is probably going to be market-ish returns.
Hmm.
In a strong bull market, it's probably going to underperform. But like the McDonald's of the world, when we go through bear markets, it's going to hold up value relatively well. So if you're looking for ballast and stability, that's what Berkshire brings. Brookfield investors aren't looking for that. They're not looking for something that's just going to do okay. They want to make money, and they want to make a lot of it, and they want to do better. So I don't think the investor base would even come close to supporting that. I also don't see a lot of places that it necessarily fits in. Unless Bruce Flatt's going to come over and just take over and he's going to actually be the next CEO and run Berkshire, then maybe you get me on board a little bit there as an owner of both of those companies. But adding an asset management business, I don't know that that's what Buffett or Berkshire would want to do as its next move. I might be completely wrong about that, but I just don't think it would make sense.
I don't. Yeah. I'm just trying to think through if I would see any regulatory antitrust issues with that. I don't know that I do, but it'd be a big deal.
It would be challenging because there's a lot of the float that's on the Toronto exchange. So yeah, there's regulatory thresholds that would have to be passed.
Yeah.
But we're up against it, buddy.
We only got about a minute left as we're waiting for Andy and Asit to come in here and you guys to keep asking your questions on them.
I'll hit Rick's that just came in on Trex, ticker TREX. I can hit that real quick.
Trex,
so,
I like Trex.
Yeah, I love Trex. Great product.
You got a Trex deck, Jason?
I don't. The deck's 30 years old here, and it needs to be rebuilt. I will have composite deck.
You are a potential customer.
No, I absolutely am. I will have a composite deck sometime in the next 6 months, and Trex is on the list of products that I will consider. What makes Trex so interesting right now is that the stock has come down. It's given up some gains. If you can think counter-cyclically and look at this business to own it when the housing market's healthy, when the economy's healthy, when interest rates ideally come down over the next couple of years, affordability improves for the industry leader that already has the best products and also have the best unit economics, the margins that they get, quality of their operations to turn those great margins into operating margin into free cash flow is incredibly good. They've already set the stage for their next step by investing the capital for expanded capacity, new facility in Arkansas. I like this business as a long-term compounder from here. I really do. Awesome. Okay. We got Andy Cross is going to be joining us. Are you hanging around or is
no, I'm not.
Andy?
Coming in with Asit.
Asit. Oh, Asit. There he is. I see Asit there now, right now. There he is. Asit, Andy.
Hey guys.
Hi, Jason. AA hour here.
Hi, Toby.
Jason,
hey,
I heard you say just as I came on, I heard you saying the phrase, "In 6 months, I will have a composite deck." And I was thinking, are we going to be pitched an amazing venture capital business that Jason is putting together? It sounded fancy. Then I realized what you're talking about.
The composite pitch deck.
Working on the pitch deck. That's right. Putting it together. All right. Well, Toby and I are going to disappear, and we're going to leave it to you guys for what I like to think of as the AA Power Hour.
I like
Thanks,
it.
you guys.
Branding.
Thanks, Jason. Thanks, Toby.
Right.
Hi, Asit.
See ya. Hey, Andy. How's it going?
Yeah, it's going well. It's going. Yeah. Good afternoon, fools. Andy Cross, Asit Sharma here. Talking all things stocks. Both of us work on our stock advisor. Welcome to the Motley Fool, Fool24. Thank you for those who have tuned in, whether you're from members over at the Motley Fool or on YouTube. Reminder, we can't give personalized financial advice. So we're here to hopefully help everybody think about investing in better ways over the next hour. So Asit, yeah, I mean, we have the jobs numbers. A lot of conversation around that. Markets are selling off on just some follow-up news on that. I think it continues to show the challenges the macro economy is kind of facing. And you know what I just continue to watch, Asit, are the employment numbers, not so much tied to what's happening at the federal government, but just what we are seeing from companies. Autodesk, which announced very healthy earnings this week, they announced they're laying off 9% of their workforce. I think companies are continuing. Google's laying off people, Microsoft's laying off people. I think we're just continue. And those are companies in strength. Companies that are going through a little bit of weakness, that they're going to be doing it even more. So I think we're just going to continue to see companies get more and more efficient in how they're deploying their employment capital, both with full-time employees as well as contractors.
Agree, Andy. And here we see things that we talk about often in opposition to each other. So companies in a position of strength may be laying off employees and optimizing because they're trying to cut costs, become more productive. Perhaps AI is figuring into that. They're using artificial intelligence to improve productivity. And that is generally positive for earnings, which pushes the stock market up. It's positive for the economy. As the economy becomes more productive, theoretically, you can increase GDP output. But there's another factor too, is then we have people who aren't employed and are looking for work again. So they're cutting back on spending. And that is, dampening. It's going the other way. So in the short term, what potentially is positive is something that can cause a lot of dislocation, and the market feels that uncertainty. It feels that sense of displacement and not understanding, what the medium term output of this is. Near term, we get it. There's a lot of flux right now. There's geopolitical flux. There obviously is, a market that's reacting to tariffs and other things. So yeah, just uncertainty, which everyone knows market is not so friendly with.
So Asit, Maya has a question. Given those current market conditions, what would be an appropriate price to buy AMD? And I will just answer that. I think we see AMD as it continues to demonstrate its relevancy in data center architecture, but also has lots of other businesses, and obviously NVIDIA is the big player in those chips. But I think we would say in AMD, generally for a diversified portfolio, we consider a buy now. So we're not so focused on the price, although you can certainly comment on that, but just maybe more in general how you're thinking about AMD.
So I'll just take the price part first to get it out of the way. It's interesting. I was on Fool24 this weekend, and I used the word cheap to describe AMD. And a member said, "Look, don't use cheap, because that means it doesn't have much intrinsic value when something's cheap. It's not great." And I had to push back against that, just to say, if you hear me saying that, I'm really using financial stock market type shop terms here. Cheap is understood to mean perhaps at a slight bargain to what fair value might be. Having said that, do I think AMD is at least fairly priced today and maybe attractively priced? Yes. To get to the answer that you were asking for, Andy, we see many things out of AMD that are pretty interesting. The first is that it's had its first run of accelerator chips that it put out in 2024, actually going back to 2023, and now it's on the next generation. So the MX, I think it's now the series is 325X. That's getting into the market now. We'll have more of a launch in the second part of the year. So it is still competing fiercely with NVIDIA. And just to remember the scale of these companies, AMD doesn't need a lot of market share to really fulfill the promise of its own GPUs. It just needs to shave a little bit off of the top. And I think you'll see that in the coming quarters and months, that AMD is going to start to solidify what its potential is, because this generation is a lot more capable than the next. And actually the one after that is the specs are put on a par with Blackwell. Now, will NVIDIA keep moving a year or two ahead of everyone else? Probably. But the fight isn't really about AMD versus NVIDIA. It's about AMD capturing its fair share of the market. We look to the data center, as Andy said. The company is making some interesting moves. It's surpassed Intel in supplying the sort of the workhorse of CPUs in servers. And so that's really great for its business. It's going to have business in very specialized chips like field programmable gate arrays as we go forward, as the rest of industry, Andy, becomes industrialized with sensors, think Internet of Things, which was a theme for so
Yeah.
long. That's now finally with generative AI coming to fruition a bit. So you see a diversified company that is executing on a lot of fronts, and they're making infrastructure investments too in the data center. They actually bought a company which builds servers and racks for the data center just to be able to piece together how that technology is best presented to customers. It's funny because the company they bought actually sells to NVIDIA. So that's how intertwined the ecosystem is. So I'll just wrap
Also,
this up.
does any of the spending, just conversations or whether rumors or some based in fact on Microsoft spending on data centers or just what we're just seeing that is out in the narrative? How does that impact your thinking around AMD?
Not that much. The hyperscalers, in my opinion, Andy, and I know you've had some thoughts on this as well. They have some committed spend moving forward because they understand the demand better than anyone else. Now, on the margins, are these smart business people? They certainly are. We were talking in our research team meeting a couple of weeks ago just about the fact that Microsoft and Amazon are both led. Their CEOs are both the former heads of their cloud units. So when you look at Satya Nadella, when you look at Andrew Jassy, they actually understand on a really granular level what it takes to service customer demand. They can project with a lot of data and many algorithms that they've been working on for years and years and years, what that forward demand looks like just from very small signals. Think about your favorite big company. Let's say it's Coca-Cola. They have probably some operations on Amazon Web Services. I don't know if they're big or small. Just by a few signs from what Coke is doing, watching them, the machine learning that's there in place at Amazon, they understand what Coke might need 6 months down the road in terms of compute and storage capacity. So when you sort of extrapolate that out, it's easier to see that they're not fools that are just throwing good money after bad and just writing big checks. They actually see the demand. Now, are they being smart and curbing some of that at the margins? Satya Nadella told us, yeah. I mean, okay, we're going to pull back some build out for data centers. Not a lot. They're still sticking to their base numbers, Andy, but he's saying, yeah, I can see where we could be leasing space ourselves and selling that or selling that back out to our customers on the margins. The big picture, if we look at it, is still a lot of demand in data center build out, which is good for companies like AMD, NVIDIA, Broadcom, that are supplying the compute power for these future AI needs. And we can,
sorry about that. Sorry.
Yeah, no problem.
I'm sorry. I thought you there.
I thought I put you to sleep because that was a long-winded answer.
Sorry, no,
So
there was just a pause there, and so no, great, thank you, thank you for that, for those answers around AMD. Just very quickly, Josiah had asked about Root, the insurance. He called it a disruptor. I'm not really familiar with Root, but it's very interesting. It's a small $2 billion insurance company that had kind of gone like the Lemonade route. Asit, it's very tech focused, P&C lines, and the stock had done very well the last few years and it just crashed and now it's kind of rebounded. Well, it is not the best run insurance company. It's when you look at the insurance metrics, which looks at the cost to operate the business, the cost of their underwriting, and then compare that to essentially 100. Most insurers run P&C, property and casualty businesses run around 100, maybe slightly lower, maybe a little bit over, kind of like that. Like Progressive, which is very well run, is kind of, I think, in the low 90s. So that's more profitable. And then they make up the difference, Asit, as you know, on their investments. Well, Root, as I can see from just looking through it a little bit, because again, I'm not familiar with it, was always one of those unprofitable insurance writers. I think Lemonade was in the same boat. And so the expectation is that they would push very aggressively to be able to grow the business and with scale to be able to do that more profitably. It took a while for that to play out. That is now starting to shift. It looks like last year Root started to generate some of those underwriting profits, or at least some of the metrics that we love to see with insurance companies, to be able to not rely only on investments for profits, but also from their operating and from their underwriting expenses to be able to be more profitable. So that has been a benefit for the stock. the big question, Asit, with all these small insurance companies is how do they sustain big losses when they get hit with big storms? And having the underwriting discipline, that is something that we've loved about Kinsale Capital that I've talked about with KNSL. So Kinsale runs at a combined ratio of like 85, maybe even lower than that, like in the 80 range. So again, 20 cents profitable just from their underwriting business, more or less, versus most companies, again, running at maybe a loss and they make it up with investments or maybe slightly profitable. And Berkshire Hathaway, obviously, more in reinsurance, but with Geico, they've been through so many, they have so many different models. I think to see that play out with a company that is just now starting to generate operating or underwriting profits is still to be determined. So, but it looks very interesting. ROOT is the ticker. Again, not one that I've really studied, but it's one I think is interesting because they are now finally starting to be a little bit more profitable on the core fundamental business that is insurance. Now, the other side of that is managing the liabilities when storms hit and what do they owe and what then their capital reserving ratio, their reserving abilities and talents are. And I don't know that without digging into Root.
It's interesting, Andy. I looked at Root several years ago when they had just hit the public markets, and the business model didn't look that enticing at all. They were projected to run at some huge losses, and I just took it away. It's fun to see maybe that its combined ratio is improving. I was just quickly trying to look while you were talking. It looks like it's slightly under 100. So meaning thereby when you take the operating efficiency and combine that with the efficiency on underwriting with losses that you have to account for. Okay, so they're on the side of being profitable, not by much, but they're certainly on a better path. And I think for me, it's figuring out with all these smaller insurance companies, newer models, many refer to these as insure techs because you're combining insurance and tech. What is the tech piece and how efficient can you get with that? And are you doing on-the-job training with the underwriting? So
yes, exactly.
I never knew this acronym, and I was talking to someone years ago. I was actually consulting with a company, and the owner of the business was saying, "Oh, she's OJT. She's OJT." What is OJT? It means you get to the job and you're learning in real time. And we've seen with some of these models, Upstart in a way was like this, Lemonade, Andy, where they learned about the actual business after they brought the tech piece to the market. Yeah. So going back, maybe taking another look at Root is in order, but those are my questions too. Okay, how do these pieces fit together? What are they really going to be good at?
Yeah, and exactly, Asit. So I don't have much more to add, although it's interesting. But I think insurance is just one that I think what we've learned is having those ones that can do at scale, very healthy underwriting. And if Root can get there, if Lemonade can get there with their friendly technology models, that can be great. But but at their fundamental, it's like a bank. Like you don't want to mess with that. Like you're an insurance company, and you can be very funny with the numbers if you want to, and you don't want companies to have to be in a position to do that. I'm not saying the Root or anyone else is, but they're an insurance company first and foremost. Tech companies kind of second. Yeah.
Sorry, I'm on mute here. Okay. So let's move to this question at the top from Susan Newton. This may be an answered question, but would like your advice, of course, for entertainment purposes only. Susan's saying, okay, I'm not trying to ask for personalized advice here, and of course, we'll keep it general. Do people continue to invest as the market slides? Andy, do you continue to invest as the market slides? I'm curious. I know the answer, but I'm
in fact, I was just writing about this today that hopefully we'll publish sometime soon. The answer is yes. And I do just quickly also want to, Susan, we are here for educational purposes as well as entertainment, just not personalized financial advice. So we are trying to be very helpful and provide guidance that each individual can take to adapt to his or her own portfolio situation. So we'd love to be entertaining. We love to be entertaining, but we also want to first and foremost be helpful and educational.
Exactly. And I believe our legal department hasn't put any kind of barrier for us to give personalized entertainment. But personalized
not
financial
as far as
advisor
I
can't.
know. As far as I know, yes. But personalized entertainment, yes. I don't think anybody wants that for me. Not personalized, but yes. Asit. So in all seriousness, I do continue to invest at different levels. Maybe I tweak on the margins as I was right. Again, that will publish sometime. Tweak on the margins. Maybe I add slightly different companies. Maybe think about cash differently. But I certainly stay invested as much as I can, and I continue to think about allocating capital in smart ways as the market is sliding and taking advantage of stocks at a discount.
Andy, for Susan's purposes, who may be a newer investor, I'm not sure. You dollar cost average sometimes?
I dollar cost average every 2 months with my paycheck into my 401k, which gets split between some funds, so more vanilla funds, and then investment account that I manage predominantly on stocks. And that money, I let the cash build to a certain level, and then I'll invest that. And so that might not get put to work every month, but I mean, I've done plenty of investing that strategy over the last 6 months, and I bought a few stocks this year.
Right, and I do
as the
I
market
do that
was
as
going
well.
down. So yeah.
And I think for many people, that's a easier way to not worry as much about where the market is going, either up or down. You just set a goal to invest regularly and just keep buying in increments through the year.
Yeah. So I think that definite answer is, Susan, if you can do that. But I think the key thing, Asit, to that is staying invested. Dollar cost averaging, if you can. The consistency is really helpful, and it's hard to do when the market is going down, especially dramatically. Like we haven't really seen, while the market is down today, we have not seen the Nasdaq's hit that correction territory, but so a lot of our stocks have fallen, and so I know that feel, but we still have not yet quite seen that, the big drawdown yet.
And Andy, we've got good. Please take the next one. Yeah.
No, Ryan asked, looking for thoughts on where one might park $500,000 in a retirement account if main concern is preserving wealth during the next year or so. So Ryan, again, not personalized financial advice, but I would say very generally. So this question, Asit, is speaking to preservation of wealth in the next year or so. And if it is truly within less than 3 years, and a person is expecting to tap that capital for different reasons, to retire, take a trip, whatever it might be, the stock market is just that could be a dicey place to be. I was talking to Robert Brokamp this morning about this, again, to the article that will be publishing sometime down the road. And the average bear market, Asit, can last. It's probably somewhere about 18 months, roughly. I'm just kind of like, the bear market of COVID average period was like only a month and a half, but the 2022 bear market that fell 25% lasted from January to October. And then you have other bear markets like the 70s and during their after the bubble burst, the tech, the .com market phase. It took years for that to get back to its highs. So you want to be very cautious. I think if anybody needs capital in the next year, certainly, or even the next 2 to 3, I think that stocks get to be a little bit. There's especially now high yield savings accounts, those kinds of things. I think is where I would want to, again, from a preservation perspective.
I like that, Andy. From a preservation perspective, hypothetically, the idea of getting some yield. And not bad yield, since interest rates are still high.
Yeah,
a decent return versus maybe risking that capital decreases if I'm going to need it in the near term. That sounds like sort of an attractive strategy for me that I would consider.
I said if we ran out a few years, let's just say we go to that 5 year. Like I'm getting close to retirement. I'm not. But say a person is getting close to retirement and they want to think a few years and they're just a little bit more in the nervous category at this level. What kinds of stocks could someone think about to be able to think about a little bit more? Again, there's no guarantees in investing. Preservation, especially at the individual stock level. preservation of capital or just a little bit maybe more of like a return on capital kind of thinking?
Andy, I think, for a 5-year period, what comes to mind first to me are stocks that may already be paying a dividend
Okay.
because they may be managing the business in order to return capital to shareholders. And
Yep.
by virtue of that, those tend to be less volatile from a business perspective. So you're buying into something which isn't trying to wow investors with a 20% revenue growth rate in 1 year. And then, I might think in terms of sectors. I think for me, consumer goods always feels like if not safe place, a relatively safe place. Yes, inflation can have an impact on that sector, but if you stick to even some of the more defensive plays within consumer goods, maybe those that are in the packaged foods business. So thinking about businesses that are snacking giants, they always seem to come out on the other side intact. Not that they can't lose value, but
Interesting.
we have a need for our indulgent occasions. And there's a reason why PepsiCo bought Frito-Lay. And now Frito-Lay is almost as important to PepsiCo's bottom line as the beverages business. But I think not to single that out when there's so many examples, but those tend to survive. And I own a few in my portfolio. That's where my head
Yeah.
goes to
Interesting.
first. What about yourself?
Well, I was thinking like NVO. So Novo
Yeah,
Nordisk is
totally.
one that we've
It's great.
recently kind of brought back to the fold for our members over in Stock Advisor, and I think that is you get a little bit of dividend yield, and you have some different variety of upside tied to all of their GLP tie-in because the stock had fallen. Like when the stock was racing a few years ago, 18 months ago, 18 months ago, I said, the dividend yield fell and it wasn't nearly as attractive. Now it's, it's not super high, but it at one point, 6% or so, you're getting a little bit of that. And I think you have a little bit of upside to there, but I do like your thinking around the dividend side. So, the studies do show, I don't have it handy, but I do know looking at this, that during volatile times when the markets are falling, dividend paying stocks, at least from the indices side, those indices tend to fall less than the market. They tend to be a little bit less volatile and they fall a little bit less. Doesn't make them immune to falling Asit, but maybe falling a little bit less. And so from a preservation side, but certainly there's no guarantees in investing. Even the best stocks that we've talked about time and time again, even the best stocks in tough markets will tend to be will fall.
Yeah, it's just the nature of investing.
Yeah.
There is risk in that path to getting some return.
Yeah.
So a question here from Bill, and I'm not going to keep going just at the top of the queue. I promise folks answer questions, but I'll pick this one off, and Andy, your thoughts are always welcome on this as well. Bill says, Asit, I know you felt ServiceNow had a high valuation not long ago. What are your thoughts now? So Bill, that's a great question. I think ServiceNow always feels a bit expensive to me because it tends to trade at a premium. And the reason is that it has great contracts with some of the biggest companies in the business sphere. And those are long-term contracts. It has a great track record at renewing those contracts when they come due. And it's very competitive. It offers its businesses or its business clients reasons to stick around. The financial model is very nice, a great free cash flow generator. Management is A grade. I see so many attributes in this company that it almost doesn't give me a chance to add shares. I always feel that way. Having said that, does it feel a little bit less pricey after the sell-off among so many tech names? Sure. This is one where dollar cost averaging might help. If you find a business that you like, it doesn't have to be ServiceNow. This is just one that I gravitate towards. It could be something that you understand, or you feel that the model is simple. You get it. The customers get it. The market gets it. Everyone gets this as a quality business. Hello, Netflix. Sometimes you just have to either buy little bits or even at some point bite the bullet and just get your shares and hang on. But the market does tend to give us opportunities, Andy, for businesses that we admire. They don't always stay at a premium, and dislocations, so the whole market retracing or a particular sector getting hit, let's say tech stocks suddenly are out of favor because, I don't know, tariffs might affect them. You get chances to buy those quality companies at certain points during a span of 1 to 2 to 3 years. But for me, maybe just buying bits at a time. Again, going back to dollar cost averaging could be the strategy here.
I think, yes, I think so. And we got this question just the other, I think maybe even yesterday, Asit, on our Stock Advisor Reveal show available to our members. At what price would you buy ServiceNow, or what would you think about going into? And I said, I kind of had at 800, that puts it less than 50 times kind of cash earnings in the 40 range. I think the same thing about Fortinet, FTNT, which is another company that got someone asked about, like these companies that have these pretty stable growth profiles for, I think that can compound earnings growth for long times. I used to, back in the years ago, used to say that's in the low 30s. And I'm kind of like in the 40 range now with those kinds of businesses. And ServiceNow, now stock's down $22 today and it's at $8.45. But also at the same time, not trying to tailor too much to a specific price, that this is the price that I'm going to definitely add into, because when it gets down there, maybe the rest of the market is selling off. There's nerves. It's hard to commit capital that way. So I think for those quality businesses, it's as much an allocation conversation, Austin. It's maybe nibbling a little here, thinking about dollar cost averaging, start here, buy a little opening position. Maybe right now what I'm doing is I think I'm buying basically half a percentage position in many of my stocks that I'm not adding more to. Opening positions, when I do open positions, maybe 0.5%. And then I will look to build on that over time based on how the business is doing not quite as much as the stock is doing. If the stock is falling and the business is still good, but the markets are pulling back, or maybe the expectations are a slight little growth slowdowns we saw with ServiceNow, and I still like the business and I want to own it for the next 3 to 5 years, then I can add my second position, but try to have that discipline, like you were saying, with dollar cost averaging over a certain amount of buying rounds. Because if not, the worry is you just talk yourself out of ever buying a really high quality business. So I don't think you have to buy it when it's at its highs, but trying to buy into business strength is what we're trying to do. Because, with Wingstop, we bought into a lot of business strength, and the valuation, even though the quarters continue to be fairly impressive, it just couldn't quite sustain that. It would have to, right. So, but it continues to be a very strong business to be able to own. Oh, you're on mute there, my man.
I'll leave myself off of the mute button. I won't touch it now. But I wanted to ask you one question on that before you take the next question. Really more to make a point here. This idea that you were talking about yesterday and you repeated today is very strong. So to underscore it, really what you're talking about is to make a investment buy decision in context. So you've been talking about allocation. It's more of an allocation question. And it's occurred to me listening to you yesterday and today that almost every buy decision, you should take that into context of the rest of your portfolio, your overall strategy. It doesn't matter if times are really great or they're like now where you're starting to think more about the effect of a purchase today of a business because the market could go down more. We should be always keeping this overlay on our investing. So I just want to underscore that for anyone who may be newer. Think in terms of context, allocation. Don't get caught up in just that one business. I mean, this is part of the principle of owning at least 25 companies.
Yeah, so that's exactly right. So allocation is a key part to it. But if you're just, in general, just building out positions, like I was saying, I think and Tom kind of laughed at me yesterday when I was like, do I own this company? I was like, do I own that? Do I own Celsius? Which we verify I do not own Celsius. But I was like, wait, did I buy that in the last year? Because I was buying over the last 3 to 5 years, was buying lots of different smaller positions that would add on to them a little bit, based on different things. Some I wouldn't. So that's a strategy where I have big positions in very core companies, the Berkshire Hathaways of the world, the Home Depots, Arista, Nvidia, we were saying Meta, those kinds of, ones that I've built up over time, then they've run. And then I have lots of smaller positions. Some have done okay and some have not done well, which is why they're basically smaller positions. And I never really bought back into them after a one or two buys because I just didn't think the business was maybe as solid, but I'm still holding on to it for right now. That's just so it's like as Tom was saying, it's a very Shelby Davis kind of buy a little bit. I learned that from my first mentor before I came to the Motley Fool. If you're interested in a business and it looks compelling, take a little nibble. It just kind of keeps you a little bit into the game a little bit more.
Right.
Ed says, how low can Wingstop go? WING. Well, I mean, unfortunately, stocks can go lower, Ed, right? And I still like a lot of what we are seeing from Wingstop. Their unit economics are outstanding. They can manage chicken wing prices as best as anybody. They have franchise demand. They have a global aspirations. They still have lots of demand. So could it go lower? It certainly could. I'm not saying that it's not, but the price is certainly attractive, in this market. And I think especially from a consumer side, it's reasonably priced food. It's in demand around social groups, that kind of thing, Asit. And so, it's very well managed, franchising model, spins out a lot of capital they use wisely. And so I think Wingstop gets, while unfortunately is down from when we had recommended, I think it's in a pretty good spot to be a market beater over time. I don't own any yet. But that's just because I just haven't bought it, but I would be a fine buyer of Wingstop today.
Yeah, I agree, Andy. I am writing up some Q&A. I think I'll be able to finish it soon. It'll probably publish next week. Wingstop is one of the questions that I'm tackling. And so it's fresh in my mind. Just wanted to relay something, sort of digesting the last earnings call that stood out to me. It's not new because I've seen this in other calls from this management team, but Mike Skipworth, the CEO, said, we're like the largest brand that no one's ever heard of. Now, he's being a little facetious there. Yeah. But what he means by that is this is a company with almost $5 billion in system-wide annual sales. And what they've done for the last couple of years since he became CEO is to tie their marketing budget to a percentage of that total system-wide sales. So they're sacrificing profitability now to spread that name awareness. And he said, look, compared to mature brands, we have a 20% gap of unaided brand awareness. So think of a big company that that's there on the fast casual or quick service scene, Chick-fil-A, McDonald's, whatever it is. So Wingstop still is relatively unknown, both domestically and certainly globally. And with all the factors Andy mentioned and the ability to really push into new markets because they are so good at the marketing and advertising side, that money's not being put to waste. They have been really using that as a growth engine. I think for those who understand that this is more of a long-term opportunity that's going to be volatile, it's a really fun idea. I can think of many companies that have less long-term potential, but maybe more solid financials because they're keeping more of their earnings on their balance sheet. This company is going out and spending the cash it generates to aid that awareness, to get into new markets, to advertise, to push its geographies. And I think really that's more of the reason to invest in a Wingstop is you have a small company, relatively small, that has big ambitions, but it has the tools to execute on that vision.
Yep. I think that's right. Sadaf had asked, how would you rate Shop Mealy at current valuation? I'm sorry, I was confusing your two questions, Sadaf. Sorry about that. Would you add Shop and Mercado Libre at current valuations? I would, Asit. Do you agree? And it's okay if you're like, maybe not so much. No. Would you add to those?
I would. I think looking around the landscape, and this is interesting because Andy and I will be working with Emily on our next stock advisor pick on the rule breaker side. And I was just thinking this week, Andy, there are many attractive companies, both on and off the scorecard, that seem like they have much better entry points for taking positions. And I don't think Shopify and Mercado Libre are exceptions to that. They both are pretty dominant in what they do. I think Shopify has been really good Andy, at opening up new total addressable market with just going to a modular system for big companies, enterprise business, saying you don't have to buy our whole system. We know you've got your own version of Shopify out there, but let us provide you this one tool. And they've gotten great uptake from large companies, brands that say, wow, let's just use everything they have. That's so much easier.
Yeah.
Mercado Libre just has brand dominance in Latin America. We are looking at the fact, Andy has been thinking about this a lot, and I have too, the fact that Mercado Libre is becoming more almost of a finance business than a very diversified business between fintech, sort of the lending part of this company, and its commerce business. It's leaning into lending. But the flip side is, and we have many investors who would say, well, you want to take those risks. If you're first to market in Latin America, maybe you want to go ahead and form the relationships with so many hundreds of thousands and millions of customers. So it's okay if they are pushing that, but a little more risky today than Mercado Libre has been in past years, I think, or we perceive. And Shopify is no stranger to competition. So neither of these without risks, but both dominant brands. That's what stands out to me in this question. Andy.
It is important to know with both those businesses that they do have growing fintech parts of their business. Yeah. That does change a little bit of the risk profile, I think. I personally think, and it's important that members and investors understand that as they continue to integrate. I mean, the way that Shopify has integrated their payments business now, and the amount of transactions that are tied to their payments business is really important, and that's additional revenue for them, Asit, right? As you know, right?
Yeah.
So because that those are good fees that Shopify can use, and they have a capital side of the business, much like Mercado Libre does. So it does change a little bit of not a little bit. It does change the risk profile of the investment, and we just want to make sure members understand that. I'm comfortable with that.
Yeah.
But it does get a little bit more into a financial discussion, and as we were talking about, is that impact the valuation, what you're willing to pay, because of market conditions on the financing arm that might change the future cash flows of the business. So that's an important stuff. But I would be comfortable adding to those both right now. Have I added to them recently? I think I added to both last year, but I don't think I've added to them recently this year. You want to take quickly the tech consultants from SADF?
Sure.
As well, and then we can continue. Yes, and yes, there's lots of great questions. A lot of them were more for Jason and Toby from the last hour. But how do you wreck the tech? How do you wreck? I hope I do not wreck the tech consultants. But how do you rank the tech consultants? Globant, Kyndryl, and Accenture.
Okay, here's how I rank them, Andy.
Oh wait, actually, let me write mine down. So, and then I can, so no one can accuse me of just following along with you. So,
okay.
Just play some elevator music for a few seconds.
I can't whistle the Jeopardy theme and also talk at the same time, but I'm going to throw you for a loop here a little bit, because I am going to rank them in 3 different ways. So for growth,
okay. Well, I'm only ranking them one way that I think which stock will be the best performer over the next 3 to 5 years.
Okay, that's a great framework. I was saying this is a hard question. So, okay, for growth, maybe Globant number 1, Kyndryl number 2, Accenture number 3. For just stability and sheer balance sheet fortitude and ability to stay in the market as a major player, Accenture, then Kyndryl, then Globant. And then perhaps earning potential for the next 3 years, I'm going to say Kyndryl, and then maybe, this becomes hard, then maybe Globant, and then maybe Accenture. So
what do you mean by earnings potential?
So if you look at these potential stock appreciation, if the expectation in the market is based on the ability to improve earnings, I should have made that a little bit clearer, then I think Kyndryl may be the most interesting out of that group. And then it becomes hard between Globant and Accenture, but I would go Globant and Accenture. So basically what I just did.
From the stock side. From the stock side.
So what I just did was I gave a non-answer because I gave them each a chance to be number 1, number 2, and number 3, but I tried to justify it.
But the way that I'm scoring it is basically your third way.
Okay, yeah, and I'm
Stock.
curious to hear your take on that.
Kyndryl, Globant, Accenture. And here's why. Here's my thinking around that. Globant stock got knocked down pretty dramatically, and I think they had some little bit of missteps that they are working through. They have deep client relationships, especially with Disney, which the Disney growth is slowing a little bit dramatically, and I think that caught some investors off. I don't want to say dramatic. Well, I guess maybe it is. The expectation is that it's not gonna grow nearly as healthy this coming year as last year. It's a smaller company. It's more dynamic. It's still, I think, very well run. They run it. They run it out of Latin America, even though they have global clients. They are not as deep or intertwined as Accenture. I mean, Accenture is a $215 billion business, and Globant might be a $10 billion business. Probably less than that. Probably more like an $8 billion business now or so. So I think just the opportunities for returns are a little bit brighter on the Globant side. Accenture will be a little bit more of a lower volatility side. Accenture they're going to report earnings at some point, and they're just coming up soon, and they're just so tied that they have 8 to 10% of their business is tied to government spending. So I want to see kind of how that plays out, how their AI bookings kind of play out. But I'm just, I think they're a little bit, the potential upside in the stock price, not as high. Kyndryl, as we talked about recently, symbol KD. What's really interesting with them, Asit, is they are continue to get that escape velocity away from IBM, and they redo a lot of their contracts. Those contracts are going to be much more profitable going forward, and that's going to drive their cash flows. Now, the stock's done very well, so some of that is undoubtedly priced in, but I don't think a lot. Their Kyndryl Bridge, I think, is a really improving solution around AI. So I think that one has the most potential because they have these legacy business. Last year, about half and half of their business was pre-IBM. In 3 years, they expect most of that, 90% or so, will be post-IBM. That will be better terms, higher quality revenue, those kinds of things we'd love to see to be able to drive revenues and cash flow. So I think Kyndryl probably has the more upside on the stock side.
So just refresh, what was your ranking again? Hold your
Kyndryl,
card up.
Globant.
Oh, that's
from a stock returns perspective, not from a volatility perspective, but Kyndryl, Globant, Accenture.
Got it. So
and I don't own Kyndryl. I own Globant and I own Accenture, but I do not own Kyndryl. So, go ahead, Asit.
Yeah. So lots of good questions. I'm going to just really briefly answer this one from Lovely Lily. Of the two advanced micro devices, symbol AMD, and Micron technology, MU, which one would be the better choice to take a position in? So Lovely Lily, I have studied Micron's business off and on. I haven't looked at it recently, but it's sort of a fun play in the technology space because, okay, it's a cyclical memory maker, but memory has become a lot more exciting in the age of generative AI. And its solutions play well for companies like, not just AMD, but also NVIDIA. Micron supplies some of this so-called high performance memory or high bandwidth memory, if you will. HBME is the latest version of that. And I think it's got some interesting potential going forward. Having said that, I study AMD much more closely, so I can't really give you a good studied answer to this question, except to say that both of those business models are really nice to have in your portfolio if you are an investor who wants to find other ways to capitalize on the growth of AI besides, let's say, NVIDIA and ASML, which is, those are two of the premier ways to invest in this space. ASML being the company that helps other companies make chips with its incredible machines. So we can move on to another question, Andy, but I like that. And it lovely made me thought, I need to go back and check in on Micron. How's it doing? Maybe it's losing some value like these other tech stocks.
When I don't really check in. Matt has asked Andy have you owned Altria, symbol MO, since it was the old Philip Morris business? Yes, I've owned it forever. I sold some off years ago, and so they kind of just sit in an old portfolio of ours and hadn't really done much, and now they've had a little bit of a bump over the last couple of months. But yeah, they're small positions. I both had owned Philip Morris and PMI. I had a question, one about from Matt also asked, hey, Asit, but I'm going to take this one, Asit. If my parents bought an RV trailer for $30,000 and then sold it about a year later for like maybe $27,000, is that akin to what Massimo did with Sound United? Well, I don't think they've announced what they are doing with Sound United yet. I may have that wrong, Asit, but I don't think they have.
I think they're looking maybe to spin it off, but I don't think
they are.
And
Matt, I think that would be a better deal for your parents than what shareholders got with Sound United. And I'm glad that they recognize. I appreciate Joe Chiani's, who founded Massimo, which is an oximeter maker, healthcare device maker for oximetry, pulse oximetry, bought a sound equipment company with some plan to have them all play together, but also be separate. And it turned out just activists kind of came in. The stock sold off 35% the day they made that announcement that they were buying it. The deal closed in, I said this before, in record time, that I think as fast of a deal I've ever seen close. So he clearly, he still owns a lot of stock in Massimo. We'll see how that all plays out because he was forced out. He ran that acquisition through, and now they're figuring out what to do with it. If anybody's going to buy it, what kind of write down they have to take off. Clearly, they may have already probably wrote down a lot of it already, Asit, I bet, as a probably discontinued operation. So that was a bad deal. And hopefully now Massimo, the new leadership person in board from Johnson & Johnson, I believe, hopefully will refocus the business back on what was a very strong business with its oximetry.
Yeah. There are a lot of things in this story that are analogous. I mean, your parents bought an RV. They thought they were going to love it and use it forever. And after the year, they tried out and said, no, this isn't for us. But as Andy said, look, I mean, the way depreciation works, the way supply and demand works, I think your folks got lucky to just lose $3K on the deal. So yes, I think they did better in that.
Jimbo on Decker's Outdoor, DECK, by the way, is one that I had. I think there was a question there maybe about from Vihan, maybe about my watch list. Decker's is definitely on there. Kyndryl on there. Both of those I think are quality business. Decker's, listen, Asit, Decker's consumer-facing brand stock had a really nice run. I have seen this time and time with Decker's as they kind of continue to build out different brands as the market ebbs and flows. Whether back in the day it used to be only Uggs pretty much, but between Uggs and Hoka and the like, I don't think there's anything out there with Decker's. Maybe the investing community is maybe more interested in Nike because of its a cheaper stock, turnaround play, those kinds of things, new leadership with Elliott Hill. But I don't think Decker's, there's any, it is a quality business. They can navigate these markets pretty well. They actually have some new leadership, which I think is in a pretty good spot with winning brands, and Hoka continues to perform both as a brand as well as on the road. So I don't think there's anything else with Decker's that is scary.
Yeah, I agree, Andy. So this is a quick one. I want to respond to Vihan here, who says, that you should consider being a bowler for a cricket team, confusing batsmen with googlies and doosras. Meaning thereby, I'm not sure what this is in reference to, but meaning thereby that I have some deceptive, like in baseball, deceptive pitches, like curveballs, Andy.
That's the googly, right? Yeah.
Yeah. So I'm interested in what I portray there, but I'll take it. I like that.
That is a compliment. That is,
I think so.
That is great.
So,
sorry.
Go ahead.
Asa, no, please go.
No,
ahead.
I was curious. Should we tackle this one from Javier Azarola? I think your thoughts on Arista Networks. Balance sheet seems strong. Valuation is looking better now. Thoughts on that one, Andy? And symbol, sorry, ANET.
Yes, ANET, and Decker's Outdoor was DECK. Yes, the valuation, I think I looked last time and it had gotten up to the high 20s, the mid or high 20s, sometime late last year. And although I may be confusing that with the trade desk, both valuations had kind of gotten up and then elevated from a price to sales ratio at levels that are just very difficult and hard to sustain. The beautiful thing with Arista, and I know Tom Gardner has recently talked about still all the positive with Arista, but they have customer concentration with Meta and with Microsoft, which is a definite risk. Granted, those two titans are spending a lot of money on data centers, but still a risk. They're tied very much to the data center build out. The other parts of the market are attractive, the campus side, but not as great as the data center side. And that data center is starting to run into maybe a little competition with NVIDIA as well too, even though Arista will talk about frenemies and all those kinds of things. But what you have going for it, Asit, is you have still growth prospects that are still very healthy, outstanding financial model, great leadership team, and a winning culture. And so those things still stand out. So, you put these all on the scales of, there's the scales of justice. This is the scales of valuation. How do you play all of these, points together and then layer over? I talk about valuation being the tablecloth or the patina that goes over an investment case with Arista. And it certainly has gotten more reasonable. And so I have not added to my Arista position recently, still continue to hold it and still think it's still attractively priced in the markets. But it does have some of those higher risk profiles considering some of the issues we talked about with spending from some of those cloud titans.
So Andy, if you look at businesses ultimately before you buy through that last lens or patina of valuation, when you're looking at the actual attributes of the company, is there any one thing that you really gravitate towards and is for you takes weight above the others, or is it situational? For this company I'm looking at, well, I think the market opportunity is really strong, so I'm okay with that being of more weight. How do you look at businesses to understand what is going to drive you to that buy decision?
Yeah,
what's important to you?
So Austin, and you and I have talked about this. To me, I try to really focus on the asset strength of the business, whether it's intellectual property or it's property. That gets to the product, that gets to the financial model that comes from the product, that gets from the market share, like those kinds of things. And that Arista scores so strongly in that zone. It's not risk-free, but they do score very strongly because of of how they have managed that business and how they have built out the EOS system and the integration into switching into the data centers that has done so well for them.
So the intellectual property in this case, the product, I mean, that's a great asset.
That drives that financial model. Great intellectual property doesn't always generate great financial models, but it clearly has with Arista. So they score so highly there. So I've always been willing to pay up a little bit for Arista, that 35 times earnings, whatever it might be. And by the way, these are real earnings. These are real, gap-based kind of earnings and smart users of capital. So yeah, I would say that is probably the first thing I honestly gravitate to first. The market opportunity, the growth prospects. That's where Arista might, and I think in Tom's case, might not be quite as attractive as maybe some other spots. And I think just worried that like the expectations of what investors might be baking in is already played out. It's not that they're not going to grow, but already played out, and the stock just is probably there's that risk profile to Arista, even though the valuation has gotten much more reasonable. So
thank you.
Susan, thank you for answering my question. It helped. I'm new to the Motley Fool. Susan, welcome. We love to hear that. Thank you for the question. We love taking all kinds of questions, and we want to help everyone who is just starting investing to be set up to understand market psychology, market cycles, business focused investing, long-term thinking, because it is, even for experienced investors like Asit and I, it is nerve-wracking when you see these stocks in your portfolios. I was just watching my portfolio fall over the last, week or so. And it's like, gosh, that hits us all because we pay so much attention to it. Not all investors do, which is also very healthy and great. Take a break from things, get out, maybe not look at your portfolio as much as we do.
true, Andy. And speaking of maybe questions geared for newer investors, Robert Scott has a question. As a strategy, should you sell enough stock shares to recover profit, then hold the cash to buy back at a lower price, or just wait for it to recover? So, Robert, I would say that it is really difficult to try to liquidate partial positions to maybe preserve part of that and then buy it back to make yourself whole. It's a lot of work. First of all, it's physical work, and it might be something that interrupts your day, and because the price has reached a point where you have to take an action. So that part is difficult. The ability to really time businesses and stocks in this way is also extremely difficult. That itself is almost a full-time job, and then very few people are actually good at it. The percentage of people who can do this, it's a more difficult exercise than it may seem in theory. So my urging to any newer investor is to consider the merits of the buy and hold strategy. Great businesses are going to outperform over the long term, and their stock prices aren't going to move in lockstep with their business results. And we have to accept this as investors and just understand that volatility, unfortunately, is part of this. Our capital compressing some, it's going to happen. But over time, if we've invested in great quality business, it's going to grow. It's going to get bigger. And then sometimes we'll see it get here and it's going to shrink a little bit again. We have to accept this. This is the way it works. So, Andy, I'd love your thoughts on this. My thoughts are, I wouldn't advise this strategy.
There was a similar question I got earlier this week, Asit. I know we're coming up to close to our hour, and thank you all for joining us here on Fool24. If the stock, my position doubles, how about selling half those profits?
All right. Yeah.
And putting them someplace else, and then keeping the original one I bought. And I think, as we were talking, I think that's a fine strategy. The only concern is that when you are out, and it's hard to do, when you are allocating capital to continued winners, and those winners keep on winning, those are really a Lollapalooza effects on our portfolio, Asit.
Yeah.
Right. And because that compounding effect, especially over, 3, 5, 10-year periods, are really valuable. I just saw that with my own portfolio with like something like Berkshire Hathaway, or just something like Chipotle. Like, you just see those compounding effects over time. So you never want to get in the way of that if you can help it. Now, the only caveat, as we talked about, Asit, is allocation. If a business gets to be, or a stock, 10, 15, 20% of a portfolio or your overall wealth, personally, that's where I start to say, even if I haven't been allocating it to a while, do I want to think about trying to pull some of that money off to de-risk my portfolio? Because the more and more concentrated a portfolio gets into one or one, a single stock, the risk profile of the portfolio increases dramatically. So you want to be careful about that.
And with that, we're at 2 p.m. And this has been such a fun hour. And I think we're welcoming maybe Jason back along with Rachel.
You got it.
Can I just answer one quick? Hi, Rachel. Jason, can I just answer one quick question from Danielle? Oh, it just vanished. I was going to answer that question about European stocks. The only one that I really talked about and recommended that looks interesting now is Saab, SAAB. Thank you for Danielle, a new European fool here. Welcome, Danielle. Saab, to me, defense contractor out of Sweden, looks interesting. Jason, I think you and I maybe talked about this before too.
Aerospace defense, great.
Aerospace defense.
Yeah.
That looks just with what we're seeing in the environment, but it's also very well run. They do have some U.S. contracts, some significant U.S. contracts that we'll see how that all plays out. But that's the European one that I like. I think all maybe 4 of us have talked about, looked at Ferrari. Maybe somebody owns it here. It's just one of those great businesses that I just kick myself for not buying when we looked at it with the valuation much more reasonable. So with that.
That's a good answer. It is that, and that's like transcending from the tough auto industry to a highly valued brand that can get the margins that it wants.
100%.
It's not easy.
Awesome.
Good to see you all.
All right.
Have a
Fools.
great
Have a
show.
fun hour.
We'll see you around.
Thanks,
All right, we'll
Asit.
unplug the double A from the socket here and
Get to the
Rachel,
junior,
hey,
junior, yeah, the JR team.
JR. I like it.
there you go. That's right.
There we
Thank you.
go.
Perfect. Yeah.
Well, hey, Jason. How's
Long
it going?
time, friend. This is wonderful. This is
I
great.
know. Happy to see your face.
I'm so happy to see you too, Rachel. And Fools, I hope you're happy to have us. Having me back, Rachel. Is this your first hour today or were you on earlier? This is your first hour, right?
Yeah, today this is my first hour.
All right. All right. Well,
Been on
that's
a
good.
lot
Well,
recently.
yeah, it's fools that aren't familiar with seeing us together. We go back a long way and we spent a lot of hours doing this format for you. And on this Friday, as we're kind of in the in-between, we've gotten the morning news, digested a lot of that with the jobs report. And we're still before we get to the end of the day where we've got a little bit of earnings still coming in next week, a little dribble. So we're just going to do an Ask Us Anything hour. And we would love for you to ask us questions broadly, stocks that you're interested in, questions that you have. Rachel knows a ton about healthcare and other stuff too. I know a little bit about a lot of companies and a lot about a few companies. So between the two of us, we can answer a lot of questions. Rachel, before we get going though, I just want to remind everybody watching, Fools, and otherwise, are we still on YouTube? I think we might still be on YouTube. I just want to remind everybody that we'll answer your questions, but remember, this is not individual investing advice. We're not here to provide personalized advice. So if it sounds like we're telling you what to do, we're not. It's sometimes easy to project that, but remember, we don't know your situation, what's right for you to do. We do not provide individual investing advice. Rachel, you want to tell the people watching how they get questions to us?
Go ahead and get those questions in the Slido. That's sli.do. The event code for that is Fool24. And any real questions you have that are about what's happening in the market, earnings, we'll do our best to answer. As Jason said, we can't give personalized investing advice, but we love talking about great companies, themes in the market. There's always a lot of fun questions that we get from viewers. And sometimes also on the show, we'll get questions about companies that maybe we don't know. We learn about a bit in real time. Always a lot of interesting ones to look at.
Yeah, no, that's exactly right. All right. Well, the questions are already starting to come in. So, all right, I'm going to take Ed's question here first while you get a chance to scan the questions. But Ed asked just at the beginning of the top of the hour here, what's a better stock long-term to buy, Tesla or Uber? I'm going to make the case for both. And then I'll give my opinion. I want to do that because for anybody watching that follows the two companies, for Uber, it's pretty clear. It's become the leader in rideshare, and they've built some diversification with we can deliver other stuff that you want us to deliver that you don't want to leave your house to go get yourself. Uber Eats has become massively successful and a big profit driver there. And the business they de-risked a few years ago because they were working on vehicular autonomy, the idea that was going to be the next leg of growth for the business. And management made the decision that, look, you trying to come off of our balance sheet to do that doesn't make sense. We need to build the biggest platform we can, and we want to be good partners with our drivers so they can share in the rewards and not feel like the more they build a successful business, the more they're pushing themselves out of a job. So they de-risked the business and have just really focused on building the platform, and they've delivered. This is when it comes again to rideshare and food delivery. This has been a big winner, and it's been a profitable winner. So I think for the future, looking forward for Uber, it's taking that platform that they've built and have become the market share leader in just about every market that they're in, especially in North America, and allowing autonomy to be part of that. And as you see autonomous vehicles come online in the next decade, whenever that happens, there's lots of speculation about when, that its platform can be the go-to for the companies that are developing autonomous vehicles, where they can participate in that without having to build their own platform to compete with Uber. So it's an interesting approach that they've taken. Tesla, on the other hand, and Toby and I were on in the 12 to 1 o'clock hour before Asit and Andy that just left. And we had an investor ask the question about Tesla's, should I be selling Tesla right now? And I want to just quickly go over the thesis for Tesla too, because this is really important to thinking about Tesla. You're betting on a lot of things. The the auto business, the EV business, this is like the foundation of the business and is what is expected to fund so many other things. So the key is if you're buying it just to be an automaker, it's an $800 billion company. You know, it's worth as much as like the 2 or 3 next largest automakers combined. It's enormous. What you're owning Tesla for is, yes, their autonomous business. By the way, they're saying they're going to have an autonomous vehicle, fully autonomous vehicle in 2026. For the past 5 years, they've said we'll have it next year or the year after. So they haven't done it yet. So whether it happens in 2026 is very debatable. They've always been really aggressive with their timelines for all of the things they've done. They've always been late, but they've always done amazing things before anybody else. So you got to give Tesla and Elon Musk a tremendous amount of credit for that. But you're owning Tesla today is not just about the vehicular autonomy for ride sharing, competing with the Ubers of the world, but it's also for the robotics business that they're building. It's for artificial intelligence. It's for renewable energy broadly. So their battery business has been really successful in utility scale storage and in residential storage. Their solar business, not so much. So the key is that with Tesla, you're buying an extremely expensive business where investors are betting on multiple next big legs up. With Uber, you're buying it based on continuing to expand and grow the platform where they've got the biggest market share. They're very profitable. They've got some level of an economic moat with the size of the platform, where the more users that use it, the more drivers that are tracks to it, the more drivers that are on it, the more availability there is for users. And it's that network effect that is it's proven so far to be a pretty good economic moat that they've delivered on. Drivers can make money in multiple ways on the platform. It's appealing to them in ways that some of the other platforms aren't. So you put all that together, and for me, I appreciate the predictability and the higher probability of success that Uber has, and much, much lower threshold of difficulty in trying to innovate with technology. We've seen with self-driving cars how incredibly difficult it has been to develop self-driving cars that can come even close in the edge case stuff to making good decisions that humans make in edge case stuff. They really, really struggle. And there's been 2 approaches. The Tesla approach using mostly cameras to be able to go kind of anywhere, building it off of the billions of miles of driving that Tesla vehicles have done, versus the geo-fenced areas that everybody else is building in, where they're only operating in very specific areas, largely relatively large metro areas, urban and suburban areas. So we're seeing different paths to try to get to a point of autonomy. And then you've got the regulatory hurdle, right? Which is another layer of challenge that's different versus a lot of things that we've seen with tech broadly that are not regulated. So I think the lower risk investment is Uber. There's more upside, I think, with Tesla, because I think if Tesla is able to deliver on robotics, any of the potential that they're working on with AI, which is tied to so many of the other things, if they can have some stake in ride hailing, whether it's with a platform they build from scratch or leveraging their technology inside of other platforms like Uber and Lyft, I think this is a $2 or $3 billion or $2 or $3 trillion business versus 800 billion today. But the math to me to get there is a lot harder than it is for Uber just to be a market beating stock. I think is probably a more realistic bet. Anything to add to that, or you want to move on to another question?
I'll leave it there. I think you covered that really well. There was actually a couple questions I wanted to hit, but to start off with, there was one that came in from Jimbo has a question about 29 minutes ago asking about Kava, Shopify, and On Holdings. And as we mentioned at the top of the hour, We are not able to give personal investing advice on the show. Jimbo was asking, what do you think of adding to these companies in the current environment? I'm happy to give my thoughts on each of these companies right now and kind of where I see them as an investor. Currently, I don't own shares in any of these businesses, but a couple of these, or well, no, what am I saying? I own shares of Shopify, but I don't own shares of Kava or On Holding. So a long-term shareholder of Shopify. But Kava is
Isn't it
one
great
I
when you
think.
own a winner for so long, you just kind of forget you own it?
Yeah, that's the thing. I was thinking, like, wait a second. No, I do own Shopify. I've held it for years.
Love it.
But yes,
Love it.
Kava is one that's been on my watch list for a while. Here are kind of some things I'm thinking about right now. With Kava specifically, I really like this business. There's been a lot of talk about how they could be potentially the next Chipotle, the Chipotle of Mediterranean food. And, there's definitely some crossover in terms of the business models when you compare Kava to Chipotle, although obviously the cuisine is different. Kava is also known for having a much more varied menu, a lot more of topping options, say, than Chipotle offers. And one of the things I've been watching with Kava specifically is they've taken a really meaningful and like strategic approach, I think, to their expansion. And I think that's something that has enabled them to gradually increase their restaurant count while still moving towards really consistent profitability. They were profitable in fiscal year 2024, as well as in the final quarter of the year. That's something that I think is impressive, especially for a business that is far less established than a Chipotle or some of these other larger competitors. I think the biggest question anyone has when looking at this type of a business right now is how is changes in consumer spending going to impact a business like this? I think that it is realistic to expect that if the tide of economic conditions turn, if things become more challenging in the macro environment, I think it's very fair to expect that consumer spending patterns will shift in kind. That's not going to just impact a company like Kava. That would impact all of these types of restaurants that we talk about. Although generally speaking, some of these quick service restaurant categories tend to be a little bit more resilient. They have a slightly lower dollar value per order, and they can tend to be more resilient in times where consumers maybe still want to spend a bit money, but less than they would spend on eating out in a larger traditional restaurant. Kava's been doing a really good job of expanding their digital revenue mix. Same restaurant sales has been growing in the nice double digits, well over 20%. They are free cash flow positive. They delivered a free cash flow of about 53 million just in 2024 and net income of about 130 million. This is a business that I like. I think anytime you're looking at this space, it's important to understand that these are businesses that are just by their nature going to be prone to cyclicality in consumer spending. I like the way that Kava has expanded gradually. I like what they're doing with very strategically picking where they put new restaurant locations. I think their financials are looking in increasingly solid shape. I do think there's tremendous opportunity for them over the long term. So, for me, looking at that, this is one I'm bullish on, really, regardless of what happens even in the coming months or even over the next year. Shopify, as I mentioned, long-term holder, which I forgot for 2 seconds, but this is a business that I love, and this is one of those that I have held it through some very bumpy periods. A few years ago, there was all this excitement when Shopify decided, hey, we're going to expand our logistics business, and then this turned out to be highly capital intensive. Historically, this is a business that had really focused on their core platform, providing, all manner of software as well as some hardware, but primarily software and tools to help merchants both online and offline grow and scale their brands. And that is something that Shopify is really, really great at doing. And when it came to logistics, that was not something that they were so great at doing. And it was something that was burning cash and profits. And they did a real shift very quickly where they're like, you know what, we're going to go ahead, we're going to sell off most of this, and we're going to
Rachel, I
focus
think
on.
there's a little more context to that too that I think is so valuable. When you're moving into a capital intensive business and your cost of capital is essentially zero,
Right.
sometimes it's worth taking the risk, right? And when they chose to move
Right.
into that, interest rates were a rounding error from zero.
Correct.
And when they chose to exit is when inflationary pressures throughout the developed world in the West cause global, basically all of the central banks to start just cranking interest rates up to fight it. And all of a sudden, cost of capital, which they were going to need to continue to leverage the capital markets more and more, went up to the point where their potential returns in this high capital intensive, lower margin business, the math no longer made sense. And management there quickly said, you know what? This was a good idea. Now it's not. And they did not waste any time moving away.
Yeah. Well, and I agree, and that's a good point. And it was an interesting time as well, because obviously there's a lot of these e-commerce businesses that also have their own, logistics system. And this is something that I think Shopify had hoped to build out, and I think realized amidst that backdrop, as well as just the general rising costs that were really moving them away from their core model, that this is not what they were doing. They went through a series of well-publicized layoffs. They downsized to really focus on their core mission. And there was a real series of bumpy quarters there. And I think the company has done a really excellent job of getting back to its roots and doing so in a really profitable way. Their free cash flow margin is expanding at just an exceptional rate. They're continuing to bring new merchants on board. They've done a lot of interesting things with adding AI tools to their platform to help make merchants' jobs easier of growing and scaling their business.
Yeah.
And I think it's really been a positive few years of seeing them go through this period that was very difficult. I remember writing about Shopify all the time during that period. I remember seeing my portfolio in the red, because this is a big
up and down
position for me.
Yeah.
And now seeing it, what I think has come out on the other side, is something that has been really notable. Now, I talked about this yesterday on the show. I think it's realistic to expect that if there is a situation where macro conditions worsen, it makes sense that merchants that are using Shopify's tools will be affected. Now, obviously, the companies that use Shopify, they're across a range of industries. Shopify provides their essential infrastructure, and that's not something that they can go without, even if customers are spending less. So if anything, I find a company like Shopify to be a much more resilient long-term way to play the future of e-commerce and retail than, say, a direct investment, on that space. And then
I think
finally,
I think so. Yeah. I think that makes sense. Yeah.
That's my personal opinion. And then kind of finally, the other ticker that Jimbo has a question mentioned was on holdings. This is one that I've stayed away from a bit. This is obviously one of those competitors to the likes of Nike and Hoka and some of these other companies we see. They're a Swiss brand. They're premium performance sports brand. They're known for their footwear, apparel, accessories. They're designed for athletic use as well as casual or leisure purposes. Most of On Holdings revenue, although they are a Swiss business, they derive most of their revenue from the Americas, although the rest comes from other parts of the world, including Europe, the Middle East, Africa, and the Asia Pacific. I think that they've been dealing with increased competition lately. I think that this is an interesting business if you want to invest in the footwear and athleisure space. I think I'm probably much more interested in a company like Lululemon, to be honest, than this one for my particular portfolio. They are growing at a really solid rate. Net sales in their recent report grew about 30% year over year, 33% on a constant currency basis. They've been doing a really exceptional job of expanding their direct to consumer share. That's about 49% of sales as of Q4. So some really good I am as in tune to as Shopify or Kava. And I just generally have not invested a lot in this space. And again, these are companies that are prone to changing consumer patterns. These are things to be aware of. I think of the three, Shopify is probably the most resilient, but I think you've got some quality businesses here, and it really just comes down to personal risk tolerance and interest there.
Yeah, I think the challenge with thinking about an on holding is that we've seen other players in athletic apparel and footwear and athleisure rise and fall. Under Armour is a good example. It was a wonderful business for a decade or so, and then it has really struggled in the 6 or 7 years since as an investment. They've stabilized a lot of things from the business, but they're no longer taking market share from the Nikes of the world. And at the same time, you mentioned Hoka, right? So Decker's Outdoor, that's one of their brands. Also an extremely popular running shoe. And what you don't see with these companies is what you generally end up seeing is that when you're really focused, like your core product is a high performance athletic product, you tend to get a very strong core fan base that is loyal to that product. It's what they wear. It's what they use. What's hard to keep are the marginal customers that are not going to run a mile in their life, but they're wearing them because it's the fashionable thing to wear. And those customers are that you can't keep those customers on loyalty, right? They're going to go to whatever becomes most fashionable. And I do think that creates risk for On. So that's why I've avoided it. So it's a version of what you were talking about, the same thing.
Yeah.
The one thing I want to say, add on to Shopify, is that I think resilient was the right word, because while they do have a certain amount of their revenue that's just recurring fixed revenue, a large percentage of it is a take rate based on total merchandise sales. So if we do go through an economic contraction where their merchants are selling less, it'll affect their revenue from that portion of the business. But it's the kind of business that if we see an overall market sell-off, particularly if it's because of the economy and concerns about the economy, Shopify is probably going to fall more than the market because of fear, but it's almost definitely going to be one that is worth buying, because it's when it recovers, we're going to see that outperformance of this strong business continue. So I like that. I like that a lot.
Yeah. Go ahead.
Yeah,
well,
go ahead. Yeah.
There was one quick question I wanted to get. It will only take me a couple of minutes, from Rachel Fan, was saying, Rachel, have you ever looked at RX site, ticker RXST? Any thoughts for or against? I just wanted to hit this really quick as healthcare related stock, and then I'll give the floor back over to you, Jason. Yeah, I'm a little bit familiar with this business. So for anyone that's not familiar, RX site, they are known for their light adjustable lens, or LAL system, which includes something called light delivery device. And they essentially sell these to cataract surgeons for use in customizing vision for patients after cataract surgery. So their primary customers are ophthalmologists who perform cataract surgeries, and their core product is the light adjustable lens LAL system, which includes an intraocular lens and then what's called the LDD, which helps adjust the lens post-surgery, as well as related accessories. And basically the design and intent behind this system is to allow surgeons to customize and optimize visual acuity for patients after cataract surgery, and that can provide a more personalized vision correction experience. So their primary revenue source is the sale of these LAL light adjustable lenses. And then this light delivery device I mentioned is a smaller portion of their overall revenue. And then there are some accessories and consumables that are related to those devices that they also derive revenue from. This is an interesting company to be. I mean, they obviously are serving a very essential and resilient need, and they're doing so in a way that has driven really significant revenue growth, as well as improving profitability. Now, under GAAP, I believe they are still unprofitable. It's worth noting in the full year 2024, they delivered revenue of about $139.9 million. That was a 57% increase year over year. In the fourth quarter, their revenue was about $40 million. That was up 41% year over year. They reported a gross profit in Q4 of $29 million, which was about 72% of revenue, although they reported a net loss of about $9.2 million for the final quarter of the year and about $28 million for the 12-month period. So I like the business idea. I think it's an interesting one, and there are not a lot of publicly traded companies we see that are in this business, and this is a durable and expanding market in which RX site operates. I think the biggest thing for me is looking to see their path to profitability. Right now, they're doing a really great job of expanding unit sales, expanding the cohorts of doctors' offices and ophthalmologists that they work with. I think that that's really important and key to their long-term growth. They're definitely in a high growth-oriented phase, which I think is really very much where we see still the lack of profitability there, as they're focusing on gearing towards towards there. I do think profitability is something that's a priority for the company in the future. For me, I'm watching this company from afar. I love medical device stocks. I like to invest in medical device companies that have a more consistent track record of profitability, which right now RxSight does not. So those are kind of my thoughts on that business. Interesting one. I think they have a lot of opportunity to disrupt the premium cataract market. Again, a huge and growing addressable market. Just more watching from afar right now till I see if that profitability improves.
All right, so I got a question here from, let me find it again real quick. So Sadaf asked, and I've got a lot of questions. We're going to try to spend the next 33 minutes answering as many as I can, as quickly as I can. So Sadaf asking, why is the PE, price to earnings ratio, so high for Brookfield Corporation, ticker BN? So I want to talk a little bit about thinking through valuation metrics to use at different periods of time for different businesses and why you would want to look at different metrics. So one of the challenges with a lot of these metrics is that things can happen at different periods of time that can affect them, that can make stocks look really cheap that are expensive, or make stocks that are expensive look cheap. And vice versa, and sometimes just completely mask the number. So in this case, if you look at Brookfield Corporation's trailing 12-month earnings, it looks like it only earned 30 cents a share. So one of the challenges with Brookfield is that it has a lot of investments on its balance sheet. Okay. So this is a little bit like Berkshire Hathaway, which in addition to the subsidiaries that it owns, also has a massive amount of publicly traded equities on its portfolio. Now, Berkshire Hathaway is subject to GAAP accounting, as the U.S. Securities and Exchange Commission requires, the SEC. Brookfield's regulator is the Canadian exchange regulator, and they use, I think, IFRS is the accounting standard that's used, and it's used by most of Europe, the Eurozone, the UK, and Canada as well. So it's not exactly the same as GAAP, but one thing that you do see where you have overlaps is something that companies have to do that can affect their net income, the reported income, but isn't reflective of their operations or their source of their cash flow. So for example, with Buffett has told us since the GAAP standards changed in the US that they report something called operating earnings. That is the recommended metric to use, because according to GAAP, the net income, for example, if the stock portfolio loses $1 billion in a quarter, the Berkshire portfolio falls from the beginning of the quarter to the end of the quarter. They have to mark to market that $1 billion loss and reflect it in GAAP, even if they didn't sell a single stock. They didn't actually realize that loss. They have to report the change in value of their equity portfolio. So that can make the value of the portfolio go up and down a lot, and that can affect net income based on GAAP in ways that aren't actually material of the business itself, right? So you have a little bit of the same thing with Brookfield Corporation. Now, there's another metric. I'm trying to find it okay, here we go. I'm going to send a slide over, Natasha and team, if we can release this for screen share. And this is distributable earnings. So distributable earnings is, I think, probably the right metric. And again, you'd want to use net income as well, kind of in the backdrop, particularly when there's periods where we don't have a lot of unbooked losses or gains that can make net income look unrealistically high or low, depending on the outcome. But distributable earnings is a little bit more useful metric, because this measures the distributions that they receive from the subsidiaries that are kind of, dividend-based payments is a big part of that. And then Brookfield Asset Management as well pays a big dividend to Brookfield Corporation through its ownership. And some other things like carried interest, if they are set to realize a gain on an investment that they hold as well. So it's kind of like the real economic earnings. And again, distributable is the key. It's essentially earnings that's in the form of cash generally that can be immediately distributed to shareholders. So if you look at that measure, now this $3.67, that's Canadian. You see it has a single vertical bar. That's Canadian dollars. That's not US dollars. So always remember, if you're looking through their presentations, it's probably the Canadian dollar that you're going to see. So if that's what you're seeing, you're going to need to come over here and you're going to need to look at Brookfield. See if I can actually get this. Well, I should probably type it in the right box. Let's start there. I know. You'd want to put in the Canadian share. So at $74.88 Canadian, based on $3.67, what is that? So 74.88 over 367, 20 times trailing distributable earnings. The US share should be like a similar, again, you're going to see a lot of correlation. It's not going to be exactly the same, but it's going to be directionally about the same. You can take those distributable earnings from Canadian dollars and adjust them to US dollars. Pretty easy to find the exchange rate to do that. And what you're going to find is a stock that on a PE ratio looks triple digits. Wow, that's crazy expensive. Oh, you know what? 20 times for a business that has consistently grown 16 to 18% annualized returns for like 30 years, all of a sudden looks like a pretty reasonable price, especially when Bruce Flatt and team says, you know what? We think we can keep growing 15% plus CAGR from here for the next 5 years plus. All of a sudden, it looks like it's a more reasonable valuation. Not too bad, huh?
Not at all.
I got one more I can hit really quick. Nick asked, thoughts on Redfin after their last earnings report and current real estate market conditions. Nick, so ticker RDFN for Redfin. I especially like the thinking about the real estate market conditions for Redfin. So the backdrop of Redfin over the past couple of years is navigating an ugly, tough existing homes real estate market. Their core business today is selling homes, listing and selling homes, existing homes. They got out of the iBuying business. There was a lot of concern that the iBuying business was going to potentially bankrupt the company because they had a ton of debt tied to a bunch of properties they own. They were able to liquidate that inventory and the business emerged okay from that. As the business sits today, based on the condition of the real estate market, they've lost market share. That you would want to think a business like this in this kind of environment would be able to gain share. They've actually lost market share. They've navigated it okay, but they're at a point right now where I really think in the next 6 months, they're going to need working capital. They're going to need to go to the secondary market, whether it's the secondary stock sale at a really, really discounted stock price. I think they would probably struggle to raise debt. If they do raise debt with like convertible notes or something, it would be at very unfavorable conversion rates. It'd be expensive debt in terms of the impact of dilution. I don't think that they think they have a lot of good options to raise capital unless Glenn Kelman can find some real magic to lower expenses while not giving up more market share. I'm a little concerned they're going to have to raise capital because it is a tough environment. And there's little indication that the existing homes market is going to prove, barring a significant lowering in interest rates. And if we see a quick leg down on interest rates, Rachel, it's because the economy is not doing good, which means people aren't going to be buying houses. So the good thing happening fast would be a bad sign because of the environment that would be most likely in. I sold a lot of my Redfin. I bought when the market was convinced that they were going to go bankrupt. I bought a sizable amount. The stock skyrocketed into the teens. I sold a good bit of it. I've still kept a decent sized position because I do have some faith in Glenn Kelman. I like the idea of the business, but I just have a really small exposure right now because the implications of the near term are concerning for me. I would need to see the business answer those concerns about liquidity, or they have to take that painful cut if they have to go to the secondary market to raise capital, and the stock's going to get hit if they do that. If they can bolster the balance sheet by doing that and also show some signs of business improvement, I would be interested. But for right now, it's a little bit in the too hard pile, and I'm not adding, but I've got a small exposure that I'm comfortable with holding to let the story kind of play out a little bit more.
Yeah. Yeah, I think I definitely have some stocks like that in my portfolio.
Yeah.
There were a couple questions I wanted to hit. One came in from Steve. He was saying, I consider TJ Maxx a vulture retailer, profits on overstock from higher end retail. With higher end department stores dying off, how will this affect TJM? And I think that's a really interesting question. So obviously the parent company is the publicly traded one, which is TJX Companies. And I think that they have a very different model that has allowed them to really differentiate themselves and continues to be really successful, even though we are already seeing and have seen, especially over the last several quarters, shifts in consumer spending. So this is obviously an off-price retailer. They also own other stores like Home Goods, Marshalls, and they're known for selling brand name and designer merchandise at significantly reduced prices, often 20 to 60% below regular retail prices. And they have a few very specific approaches to how they set up their stores, like TJ Maxx or TK Maxx in the UK, which has made them, I think, very different than the old school model of department stores, despite, in addition to the fact that they're, significantly off and down from the prices of the original retailer. For one, their inventory is constantly changing. So they feature a mix of items from various brands, including closeouts, overstock, excess inventory from other retailers. They don't engage in promotional pricing like sales or coupons. The focus is just always on very consistently low prices, which is something that has been really effective with the end consumer. They will buy merchandise, for example, that department stores have canceled orders for, and they will buy that merchandise and sell it in their stores. They buy merchandise that manufacturers have made too much of. And they also buy what's called closeouts, which is merchandise that vendors want to get rid of at the end of the season. And by selling that merchandise already at a really, really steep discount and then laying their merchandise out in the store very differently than other retailers, it creates something like a treasure hunt shopping experience that has been really, really popular with shoppers. The other thing that is kind of unique about their specific model is they operate with a very flexible buying model. So unlike traditional retailers and the old department store method where you have retailers that are locking in inventory months in advance, they don't do that. They buy that surplus merchandise to sell it right away. They have very rapid inventory turnover, which is something like 9 or 10 times a year, which helps them avoid carrying costs and the potential for products becoming obsolete. And the other thing that's very different from traditional retailers is they do not hold replenishment stock in back rooms. Often store managers don't even know what's coming in until the delivery truck arrives.
Yeah.
And it's been a really...
And that's a feature, not a flaw, right? That's the
key. These are all elements that are key to their model. And then they do have their own private label and exclusive products. So these are just some of the ways in which I think that they're very, very different from a traditional department store model. And I think that's important to emphasize as we're looking at the broader retail space. Something else that has been particularly interesting with this company and some of their brands, some of them, like Home Goods, is a great example. You're not actually able to shop online. You have to go in store. And that is, again, a feature, not a flaw, as you mentioned, Jason. And that has been really effective. So, again,
well, the return rates for those sorts of items on e-commerce are high.
Right.
And they do not want that. They do not want that. So any upside from increasing revenue that would add on operating expense and having to churn merchandise back through, they want to avoid. So tying that into like you said, like the treasure hunt mentality, like the model, they're just so good. They're so good operators. They really, really are.
Well, they really are. And again, like those steps I mentioned that help them really avoid the issue of excess inventory, that rapid turnover, and again, putting that in the store right away, not keeping that back stock in, in the replenishment stage in the back room is something that has been really essential for them. And even with their stores like TJ Maxx, they have e-commerce sites, but there's very limited items that you can shop online on the website. And so it creates this dynamic where shoppers are incentivized to create foot traffic and come in the store. And this has really lent itself to really solid sales growth as well as, profitability for the business. So I think that if anything, this is a company that has proven its ability to succeed as the old department store model is dying off. They have completely taken that old model, thrown it out the window, and built their own, and it has been very effective. And I think that that's also something where, in an environment where shoppers might be more constrained, I do think that that low cost model is something that will be attractive. And I think they've created a really resilient, less capital intensive model that will give them more optionality, even if macro conditions worsen for a period.
One of the things that's so powerful about that business model, Rachel, and the value proposition that they have is that they're not targeting lower income shoppers. They're targeting value shoppers. And what we
Right.
see is, in that counter-cyclical way, when we do go through periods of economic uncertainty, and even during a recession, higher income shoppers that still have plenty of disposable income will go to those stores knowing they're going to find great brand quality products at discount prices. And at the same time, people that are just trying to save money, that don't have discretionary income, are also going to benefit as well. So it is a great counter-cyclical business, and the returns, like you look at the return on capital that business has generated, over 25 years, it's just been a massive winner. Such a wonderful business.
Yeah, no, I definitely agree with you there. Totally switching gears to a different industry. We had a question from Ed about Upstart. This is a company I talk about a lot. Ed was asking, looking at the downward spiral with Upstart, $52 a share. Someone does not like their business. Is the downturn due to bad loans on their book? Do you think this is a buy? So a few things I want to say about their company and how they work, and my thoughts here. So I think it's important to understand what the environment is that has been feeding into Upstart's performance in recent quarters. So Upstart is a platform that essentially acts as a middleman between individuals that are seeking loans, that are seeking access to credit, and institutions, banks, credit unions that provide access to that credit. And Upstart's platform uses artificial intelligence and machine learning to help drive more informed lending decisions. They leverage over 1,600 different variables and data points to determine whether or not to approve a loan. And how they make money is from fees attached to servicing loans. Unlike traditional lenders, they don't directly provide the loans to borrowers. They simply connect borrowers with lending partners. So their primary source of revenue comes from fees that are charged to banks and credit unions for each loan that is originated through their platform. And they also earn some revenue from platform fees for each loan that's originated through their system. Now, part of the reason Upstart has been dealing with such challenges the last few years is obviously this has been a challenging lending environment. And Upstart's platform is highly calibrative. So it continues to change and learn and upgrade based on the environment at hand. So in a time where the cost of funding loans has been extremely high compared to past periods for institutional partners, and in a time where risk of default has been higher, so individuals are in some cases applying for fewer loans, or if they are applying, are being rejected. This has created a dynamic that has made it very difficult for Upstart's platform to function in the way it was designed. The fact that they have been dealing with a major contraction in loan volume is also a function of how their platform works, right? They've been approving fewer loans due to the nature of the environment they've been operating in, and institutional investors have been buying fewer loans. Now, recently, they have garnered numerous new capital commitments from institutional partners who will be funding current and upcoming loans. They launched a home equity line of credit program. They noted that of the roughly 1,000 HELOC loans they've helped facilitate in 2024, they had 0 defaults. They also have an extensive auto lending program, and their platform continues to upgrade and refine and improve. Over 90% of loans facilitated through their platform are fully automated. The biggest challenge for this business is, where does it go if macro conditions worsen? We're seeing a situation where their net losses are finally starting to shrink again. They're starting to see sequential revenue growth again that is in positive territory. And in this dynamic where the last couple of years the lending environment has been really difficult, they have continued to really rapidly expand their network of bank and credit union partners, as well as institutional partners, they carry a very small percentage of loans on their balance sheet, even in sort of the most difficult of times in this last couple years. Still, the majority of
the loans they keep largely are for testing when they're building new products. They hold them.
Yeah.
When they make changes to their algo, they'll keep a small portion to more accurately measure performance of the loan.
Right.
So that's most of the loans that they have. Yeah.
Yeah, they've carried a very small amount, something like 85, 86 or more percent are completely funded by institutional partners. So I love this business. I have continued to really like it. I've covered it a lot for the Fool. And as I've kind of mentioned many times in writing about it, the fact that loan volume has contracted, which has led to, deep unprofitability, declining revenue, has been a function of their platform working the way it's supposed to and adjusting to the environment at hand. So theoretically, and as we've been seeing in the last few quarters, as that environment improves, as loan volume increases, as risk of default goes down, and institutional partners become more inclined to fund loans, which is something we've seen even in the last couple quarters, given updates from management, those are all things that really bode well for Upstart. Obviously, there's a lot of uncertainty right now about the macro environment. I still think there's a lot of potential with this business. I think it's obviously not probably for anyone that has a low level of risk appetite. For me personally, this is one I find really intriguing for the long term. I still think the value proposition is there. I think that they have been operating in a really difficult time, and they've been, I think, managing their business as efficiently as possible. And I think that if conditions continue to improve in lending, I think there's a lot of opportunity for the business. But this is one that I think it will take years to reach that final fruition. I think that there's just a lot of hurdles they've had to deal with the last few years that have been broadly outside of their control, but have really trickled down to what we've seen in their balance sheet.
It's macro. I'm going to share a couple slides here because there's some context around the near term with the stock that I think might be helpful for Ed and others. So this is from their Q4 report. So when we saw the stock price really shoot up in to begin the year, a lot of it was driven by this. Revenue was up 56%. Gutted. I mean, they massively lowered their losses, substantially lowered their losses.
Substantially. Yeah.
And again, 56% revenue growth in the quarter, 24% for the year. There was just a huge quarter, and the year started off pretty good. The stock was up a ton last year. Yeah. Macro has been the thing that's affected this business the most. Interest rates went up, banks stopped issuing personal loans, and we're starting to see the banks are coming back, right? They have over 100 bank partners. Most of them have become partners in the past 2 or 3 years. That's setting the table. The guidance, let's see if I can find I'm trying not to make everybody dizzy, but I
love that whenever I talk about this stock, I'm the only person on the show that's enthusiastic about it. So I appreciate your enthusiasm about Upstart.
Yeah. So well, the numbers are there. So their full year guidance for fiscal 2025, $1 billion in revenue. Again, so that works out to like 40% revenue growth. It is a huge jump forward. All right. Let's talk about what's happened with the stock. I'm going to pull everything. So you see the purple line here. This is the stock price, right? So the stock ramped up, and then here recently, this is what happened. This is the mechanics of the market. So the comment was something along the lines of somebody doesn't like the stock. There's a lot of somebodies that don't like the stock. The short percentage of share of float. So this is basically available shares. So shares held by institutions, shares held by insiders are not part of the float. The shares that the founders of this business own, they're not being traded. They're not available to short. So the float. So we were in the 30s for much of this period. And you see, really going back to the fall, they reported Q3 and it was a good number and their guidance was big. And then the election happened and there's a lot of like, the economy is going to be good. That's going to be good for lenders like Upstart. The stock skyrocketed. A lot of shorts were getting squeezed hard. So we saw a lot of shorts sell off. Now here more recently, since we got that quarterly filing,
right,
we haven't gotten an update on shorts. We're due to get an update next week, I believe, on what the short percentages are, what those numbers look like. I guarantee you're going to see that it's going back up. You're absolutely guaranteed to see that it's going back up. And the reason I believe that is because the stock price has been pushed down very aggressively. But we've also seen every tech platform stock that was a big winner over the past 6 months to a year come down a lot as well. This isn't anything that has a lick to do with what's on the balance sheet, with bad loans or any of that kind of stuff.
Yep.
This is the market reacting to a stock that went up and has a lot of binary outcome thoughts from a lot of investors, and bears are piling on. At the same time, you're probably seeing some people that have rode that wave up that are selling, that are taking gains, taking money off the table, however you want to describe it. People that made money are now selling to lock in those gains, and shorts are probably increasing at the same time. All right, I got a bunch of questions that people have asked me that I need to. I'm going to try to power through like 3.
Do it.
So I'm gonna ignore the ones that were asked of Jason Moser that I know were for Moser. A couple of days ago, Matt asked what my favorite stock was. Matt, you have to know, I have so many stocks. I don't have a favorite. I really don't. I don't have a favorite. But right now, I'm really compelled by some of these counter-cyclical ideas that I've talked about. Stocks that have exposure to some industries that are down, that I think the stock price has fallen more than the long-term implications for the business, that I like the upside. And I would put most of the Brookfield businesses in that, because the idea of interest rates and inflation pressuring those businesses, the pressures on renewables, cost of capital, and regulatory things, I think those are overblown. And I think the long-term, these are businesses that are going to win going forward. Okay, so Vihan asked thoughts on ARE, which is Alexandria Real Estate. This is a real estate investment trust, a REIT, that's actually in pharma and biotech. That's really their properties that they own are primarily for healthcare tech, biotech, and pharma companies. There was a little bit of an overbuild in that sector. I live near Boston. This is one of the biotech centers in the world, really, and there was a massive oversupply of real estate in this area. I think that's affected their business a little bit. I think there's other areas of real estate that I think are more compelling than that particular business. If you're looking for a stable business, again, Vihan, as you know, I'm not telling you individually what might be the best fit for you, but I think for investors that are looking for stability with a high floor, a good yield, and maybe not a ton of growth, but some decent growth, I think Realty Income is interesting. Some moves that they made to expand into other areas of experiential, like gaming, over the past couple of years, offer some upside. I think Prologis, PLB, I believe is the ticker, or PL. I got to look it up. Maybe it's PLD. I apologize. I want to make sure I say the ticker here right. I always get it mixed up for PLD. Yeah, is interesting. The stocks kind of come back a little bit, but I think it's still interesting at this price, because their cost of capital beats everybody in industrial real estate. They're a real leader there. Vihan also asked about CHCT, which Community Healthcare Trust, I believe, is the name. It's another healthcare REIT. They focus more on like outpatient facilities. I don't love that business. I don't think I ever owned it, Vihan. I've talked about it before, and it's okay, but I think some of the ideas, some of the tailwinds around healthcare, it gets looped into that. And there might be some just because of the aging demographics in the US are going to increase the need for these sorts of spaces. But honestly, their tenants in these kind of spaces are a lot of times are tough businesses, that their margins are thin, their staffing challenges, a lot of regulation that weighs on those businesses. And in most cases, I think necessary regulation for patient protection, patient care. I don't love that business a lot. Vihan also asked about Boston Omaha, ticker BOC. Do I still own BOC? Where do I stand with Boston Omaha? I've made a decision. They're reporting probably around the end of the month, Rachel. They don't pre-announce when they're going to report. They just drop their release. Like they don't issue a press release saying when they're going to release it. They drop it. This will be their annual report. They just do it. They just throw it out there. Yeah. I've been so disappointed in this business and their ability to be good operators of the businesses that they control and generate returns from that. The thing that I'm waiting to see is their fiber business, their high-speed internet business. There's a lot of capital that they put in that's kind of tied up based on residential real estate development, because they're partnered and tied to new residential communities that are being built. That's the upside there. Seeing some signs that they're becoming better operators. If I don't see something that tells me that they're moving forward with their ability to be better disciplined operators, I'm going to sell. Like, that's where I am. So I would say by mid-April, there's a very good probability I will no longer own Boston Omaha. I will be making videos. I will be talking about it here on Fool24, writing articles about what I choose to do based on what they announce and what management has to say. We'll get a shareholder letter then too, because it's their Q4. But they're going to have to do a lot of work to keep me as a shareholder.
There was a question I wanted to hit from Van Doe saying, with investments in AI, is a cure for cancer more likely to come from a big pharma type company with lots of capital or a smaller, more focused biotech? And I have a few thoughts on this. One thing I think that's important to understand is I don't think it's realistic to expect that there will ever be a single cure for cancer, because this is a group of over 200 or more distinct diseases. They all have unique characteristics and behaviors and genetic makeup, and a lot of them require very individualized treatment approaches. Even the different cells within a single tumor can vary broadly, and these cancers all behave differently. They grow at varying rates. They respond to treatments in diverse ways. And because of metastases, which is spreading to other parts of the body, it can make it really difficult to completely eradicate the disease. That being said, there are a lot of companies, including big pharma businesses, big biotechs, and smaller biotechs, that are working on many different types of targeted therapies and drugs that I think could revolutionize, or are already revolutionizing the landscape of cancer care. So I think that's one thing to kind of keep in the back of the mind as we think about what that looks like in the context of investable companies. Just to kind of name some companies off the top of my head that are major players in the oncology space. Johnson & Johnson is one of them. Pfizer is another one. They had a major $43 billion acquisition of Seagen, which was one of many acquisitions that they made with the profits and cash from their COVID-19 vaccine. Pfizer's acquisition of Seagen effectively doubled their pipeline and is a huge part of their push to have 8 oncology blockbuster drugs in their portfolio by the early 2030s. They're already well known for their cancer drugs, Ibrance being one of their top selling drugs and a major treatment option for patients with metastatic breast cancer. Merck with their cancer drug Keytruda as another one. Merck is also partnering with Moderna, and Moderna is developing a cancer vaccine that is being tested in patients who are also taking Keytruda. So those are a couple other companies to be aware of. Novartis, AbbVie, Eli Lilly, these are all companies with really extensive burgeoning oncology pipelines, as well as existing drugs in their portfolios. Then there's some smaller biotechs. We've got ones like Summit Therapeutics. They're really focused on developing cancer therapies in the area of precision medicine. There's companies like Novocure, and they're focused on developing cancer therapies, including tumor treating fields. You think of other businesses as well, like Gilead Sciences. They have a growing oncology pipeline that includes CAR T cell therapies. There are a lot of ways to invest in the potential of the space, and I think the more likely reality is that as the study and treatment of the hundreds of different types of cancers grows and evolves, I think there will be players from all over the space, both big established companies like the ones I've mentioned, as well as smaller, newer biotechs that have an opportunity to revolutionize the standard of care in this space. So there's a lot of opportunity. These are all companies that I find really interesting, some of which I own, and many of which are major leaders or potential future leaders in the oncology drug space. So we definitely wanted to hit that.
All right, so we are up against it, my friend. I'm sitting here reading the queue for more questions. I look up and I realize it is 3.
It went by too fast, Jason. I'm sad.
Yeah, no, it has flown by. Well, Rachel, this is going to be it for the Q&A for I believe for the next hour, we've got a pre-recorded video with Andy and Tom, and I think Rich was on here with him as well, interviewing Sezzle CEO Charlie Youakim. So I believe it is time for me and you to do the Mickey Mouse Club thing and say goodbye.
Fool on, Jason.
All right, fools. There'll be a momentary interlude while Natasha and friends bring up the video. So enjoy the video. Be sure to stay around for the 5 o'clock hour, and there's going to be a tech earnings roundup, and that's going to be with Toby and Will. So if you got more questions, come back for the 5 p.m. hour for that. In the meantime, enjoy. Oh, nope, sorry. That's going to be Danny and Jeremy, and then Toby and Will. So, but in the meantime, enjoy this interview with Sezzle's CEO. All right, fools, fool on.
Hello, everyone. Welcome to another Motley Fool conversation. I'm Andy Cross, joined by Motley Fool founder and CEO Tom Gardner and Motley Fool contributor Rich Lumelleau. Today, we're speaking with Charlie Youakim, founder and CEO of Sezzle, a $1.7 billion buy now, pay later company headquartered in Minnesota. Charlie, welcome to the Motley Fool, and thank you for being here.
Thanks for having me. Longtime fan.
That's great. Well, Charlie, we're excited to have the conversation with you, talk all things Sezzle, which is really exciting. It's a recommendation of ours, so we're excited to get right into it and just talk a little bit maybe about the buy now, pay later company you founded. Can you explain what Sezzle does for our members, and really why is it different in a very competitive buy now, pay later space?
Yeah, one quick way to describe it, even to my mom when we first started the company, was think of like reverse layaway. Basically in the old days with layaway, you'd make a purchase, but you'd have to wait for the product. Buy now, pay later is an innovation upon that, where it's basically, I call it reverse layaway, because you make the purchase, you get the product up front, but the payment plan still exists, pay in 4. So it's 4 payments, interest-free, over a 6-week time period. So 25% down today, 2 weeks, 4 weeks, 6 weeks. And we automate the payment plan for the customer. And the reason it became very, very popular in a short period of time was it really made a massive difference for the merchant in terms of driving conversions, driving sales, increasing basket sizes, and just changing decision-making for the customer. And our customer tends to be like a mid to low income, younger customer. And what was going through their mindset when they're making this purchase decision was, I could budget for that product. I'll come back later. And, I don't want to use my credit card. 65% of our customers have a credit card, but they just choose to pay us with debit cards. They don't like to use the credit card. And so they say, I'll come back and buy it later. But merchants know that the customer is not going to come back. So we changed the buying behavior by basically putting the budgeting tool on the website and telling the customer about it, that you can pay in 4 for this over 6 weeks. And, a lot of these customers get paid bi-weekly. And so the customers felt very comfortable that I could basically budget for this, make the decision to buy it now. And they also felt comfortable with the credit product in that there was never a chance for like a credit card to create a burden in the future or some sort of stress where now maybe I overspent a little bit and I can't pay that off in full next month. And now I've got this balance that I got to pay interest rate on. So I think that's what the aha was on the consumer side and on the merchant side. And that's why we've had this just dramatic growth in our sector and with Sezzle as well.
And Charlie, if I can ask, so with regard to loss provisions with your clients, it's kind of around 2.5% to 3%. How does that rate versus, say, the industry standard? What is your target goal? And kind of which way has that number been moving for you folks?
It's really moved in the industry and among different players at different growth stages between 1% and 3%, I would say. That's really been where the entire industry has varied. In our history, we've had, a couple of years back, we were probably around this 1.2, 1.3% area. But that was a different time period for us as well. At that moment, we were less growth oriented because we were fixing things. I call it techpocalypse. We were a money burning machine back in 2022. 2023, we fixed a lot of that. 2024, we fixed even more. So when we were fixing things and getting to profitability, we weren't pushing for growth. And so the reason that it ranges from 1 to 3% is really, in my view, the growth stage or the growth orientation of the company. And the reason that that's worth mentioning is because new customer cohorts, when they come into any one of our companies, they have higher loss rates, significantly higher loss rates than existing customer cohorts. And there's a little bit of a dynamic about the buy now, pay later product, and Sezzle is a part of that. And I think we're all very similar in this regard. If you fail on one of those payments in your payment plan, Sezzle locks you out from making another purchase. We don't want you to go over your skis, which I think is another reason why customers like us over a credit card. We don't allow them to go too far. You're stopped. If you can't make a payment, you can't go further. And that's why existing customer cohorts have very low loss rates, because they love the product. They want to keep on sticking with it. And so they stay current. And if they run into a hiccup, they catch up, they stay current. So you tend to find these like existing customer cohorts are very, very stable. And I think that's across many of our companies. When you bring in new user groups, unfortunately, no matter how good your underwriting systems are, a portion of that new user group just, you almost call it like first party fraud. They were never planning to pay you back, a portion of them. And unfortunately, that raises the entire cohort's loss rate to a much larger extent. And so that's really the dynamic, at least for Sezzle in our past. It's been the growth stage of the company. So when we were pulling back, pushing to profitability, loss rates came down. Now we basically built out the better lemonade stand in our view. And now we want to tell the world about it. We want to bring people to the lemonade stand. We're growing faster, loss rates higher. And that's why we gave guidance towards a higher loss rate for 2025 as well, 2.5 to 3.
Okay.
It's funny, as we created the Motley Fool back in 1993, we really came to the world as investors in the stock market because our dad had taught us about the subject as kids in a very fun, accessible way. But as we expanded, we started to realize that all these other financial issues faced people in life before they could get started investing, or they would get in the way of their investment plan because a job change or the market would decline substantially, and they would have an emotional reaction to it. So the complexity just has expanded so much. And I do remember when I first started learning about credit cards and realizing like the credit cards don't want to stop you on average. They're very happy to take you up to the point. In fact, one of those, one of the earliest gifts you get on college campuses is the introduction, not just to the card that you've gotten, but now the ability to expand the range that you have to borrow just at an interest rate a little bit higher than it was before. And what a great gift that is to the credit card companies. So, it's a complex world out there, and a lot of young people don't really know where to go. So I definitely want to talk in a second about being a B Corp and how interesting I find that you've chosen that path. But I want to reset one more time just to help our members understand the three primary players here in a transaction. So maybe take a classic case study of who is it, who's your sort of classic customer, what are they actually buying? And then what's Sezzle's part, what's the merchant's part, and what's the customer's part? Even though you've done a good job already with it, I think just walking us through one transaction would help.
Sure, and I'll go back to your credit card story because there's an interesting dynamic here. I think you've nailed it, Tom. Some of these things you mentioned. So the dynamics of like the interplay between the customers, or the stakeholders. When we first started the business, what we would do is we go to retailers and we tell retailers, put Sezzle on your site as in the checkout, much like PayPal. Put us in the checkout. Put us on your product page, though. That was actually one of the most important keys. Put us on your product page, and when you're selling a product, in our typical products early days, the key price points are $100 to $200. So I always give like an example of a pair of jeans, or you're buying a sweater. Fashion and apparel, beauty and cosmetics were the core at the start. So you're buying a pair of jeans for $100. On the site, it would say, or 4 interest-free payments of $25 with Sezzle. And you could click on that little advertisement widget and find out more, because early days, it seemed like it was too good to be true for the customer. So they had to learn more about, this is real. And then what would happen is, okay, and then in that transaction, the merchant would pay us like a 6% plus 30 cents. That was our rack rate of our product. Blended average right now is more like 5% because we have larger merchants in the mix. So they'd pay us like we're a processor, the retailer. So the customer decides, I want to buy that pair of jeans. They go to the checkout, they choose Sezzle, they sign up with us. We make the payment plan for that customer and fulfill the purchase. We pay the retailer the $100 minus the 5% blended average we have. So less the $5. So the retailer gets $95. They're happy. I got $95. It's $2 more than I would have made, or 2 less than I would have made if I would have processed with Stripe, but I still got 95 and made a sale. And they've got margins that are like 60%. 60% margin, so they're happy. So they make the sale, they ship the product, customer gets the product, and then they now have a Sezzle account, and they make the payments to Sezzle automated. It's all automated. They don't have to think about it, and those payments come into Sezzle over that 6-week period. And that's basically the interplay between customer, retailer, and Sezzle. Original model. What Sezzle's done that has really made us attractive as a company, I think, to investors, and just as a growth company now, is we've continued to innovate. I'm an entrepreneur. I'm a believer in innovation, and the innovation that we launched, or the innovations, was more of a direct-to-consumer model. We have now 2 subscription levels and a pay-as-you-go product that allows the customer. Originally they were kind of locked into our network of 25,000 merchants. They could shop at all those merchants in our app. We launched Premium in 2022, which allowed the customer to shop at 300 top merchants in the United States through our app if they paid us $12.95 per month. And that unlocked a lot of places to shop that the customers were asking for. And so now there's less of a relationship with the merchant, or at least less of a direct relationship with the merchant. They'd still go shop. The customer would shop at the merchant. We'd finance it. We'd pay the merchant through interchange, through like either a gift card or through a credit card. We'd pay the merchant. They'd get their funding. But then the customer would just pay us back directly. And then we launched Anywhere the next year, which allowed the customer to get a virtual card and just shop anywhere for $17.95 per month. And then this year, or this past year, just a few months ago, we launched something called On Demand, which didn't require a subscription. You could just basically pay a service fee, almost like an ATM fee, $4 every time you shop. When you make a transaction, you just pay $4 and we'll transact. No reason to get into a subscription. So that's basically like the interplay right now between Sezzle, merchants, and consumers. And then
Charlie, there's a.
Oh, go ahead, Andy.
Sorry, Charlie. I was just going to quick follow up. There's a financing arm to this that you partner with various firms, like WebBank, for example, that have to that fund the ability for you to be able to pay the retailer, and then you pay a rate on that.
Absolutely, yeah. So WebBank is our banking as a service partner. They enable our on-demand product because it's a finance charge, essentially. So that's where WebBank plays into it. This is a partner, and we just launched them in October of last year, or late September. But you're right. We lend to the customer, essentially. We borrow from a group called Bastion. They've worked with us for the last 6 years, and they lend to us at SOFR plus 6.25 or so, somewhere in that range. And that's our funding facility through to the customer.
Okay, great. But Charlie, could you just and sorry, Rich, I'll just quick jump in with a follow-up question on just the subscription offerings, Charlie, because that's a unique proposition in the buy now, pay later space. And I just want to make sure our members understand kind of, so an average monthly rate maybe of $15 or something, $15 to $16. Yep. And you're talking about, hundreds of thousands of people who are subscribing to the Sezzle subscription offerings. And I just want to make sure because that's that is different than what you see from some of the other buy now, pay later providers.
Yeah, most of the other buy now, pay later providers are really focused on the merchant relationship, which was the original model. And I think if you look at Sezzle right now, we're the most complete. So there's one of our competitors, Zip, has what we call on demand. We saw them launch it. We liked it. We knew we wanted it. We needed it. But we're, I think, the only player that has a very strong subscription offering, from what I can see at least. I know Afterpay launched one, and that they no longer have it. I don't know why. Klarna has one, but it doesn't seem to be a large percentage of their business like ours is. I don't know why again. And it's basically Sezzle with this subscription offering that seems to be, it definitely is an important part of our business. So we're definitely unique in that regard. And I think part of the reason why it's such a good product for the customer is, like all of us, we have this like heuristic or natural human laziness. When you're signed up for a subscription, you don't have to think about when you're going to a site, which one of these am I going to use? You just use Sezzle. And that's worth the $15 a month. I don't have to think about it. I just use Sezzle. I don't have to look at the checkout, who's there. I just use Sezzle. So I think it's solved that kind of pain point for the customer.
Yeah. And on the back of that, Charlie, so when you first, I think when a lot of us first encounter BNPL, it's retail, right? You're on the Target site or the Nike site or Amazon site. But if they go to one of the products like Premium, in theory, that opens them up. They can, they can go out and purchase food. They can buy parts for their car. They can, healthcare. Like you can do almost anything with that, right?
Exactly. And that solves, the biggest complaints we had from customers early, and we watch the complaints channels and the high fives channel, basically, both one and the same. And the biggest complaint was, Sezzle, why aren't you at Nike? Why aren't you at Adidas? And we're like, we're working on it. Trust me, we're working on it. We're trying to sell Adidas. We're trying to sell Nike. We're trying to sell all these retailers. And so we realized later was like, we just got to solve this problem. It's going to take years to get every one of these retailers on board. The customer's not going to wait years. They want it now. And so our solution was this subscription offering at the start. We thought that was the best way to unlock it, and it became a big home run for customers.
I'm not a financing lending expert. I did talk to somebody who spends a lot of time studying buy now, pay later companies. And their primary question was, what happens as the model scales? And sourcing the capital to, cover the X number of weeks that you are waiting to get the payment back from the customer. What happens if this company is 5 times larger? How do you see the pathway to making all the partnerships work and the financing arrangements work, including in different macroeconomic environments, to the extent that that has an impact on your model?
Yeah, great question, Tom. I mean, I think I believe in scaling big time when I'm building a company. Like that's what makes a company attractive. It's its ability to scale. So a couple of years back when we were going through this, reinventing of the company and getting to profitability and continue to push forward, we told investors, watch us. We are going to show you how well this company scales. And I knew it scaled. I'll tell you like early example. When we first launched, we had our first holiday season. We probably had like 6 people in the company. This is like 2017, the first holiday season, 6 people in the company. The thing just ran automated over the holiday season. Like no one's in the office, it's so like intrinsically I knew this scales incredibly well. Like, I mean, it was not a massive holiday season compared to what we have today, but it was like, it's software. It's just running, so we knew it scaled. And so I said to investors a couple years back, and we keep on saying this because it's my favorite chart. We always talk about it. Look at our operational expenses versus our gross margin dollars. And we're going to show you how we can have a different angle of inclination on those 2 lines and show you how well it scales, because we don't need to grow OpEx to grow revenue and grow gross margin dollars. And then in terms of the funding mechanism, it's because people have a question about that. The beauty of BNPL is it's very funding light. Personally, I don't want to go longer term with the company. I don't like, because you create a really heavy cash burden, cash flow. Driving cash flow in a business is important to the valuation of the business. And when you have a long-term financing activity, there's a lot of cash demand. With our product, it's essentially a 3-week product, because we take 25% at point of sale, and then the last payment's at 6 weeks. So put the teeter-totter on, it's a 3-week product. Our last couple of quarters, our draw on our line was 90 million and like 105, I think, the last of this quarter. And if you think about that, we're doing over 2 billion, in terms of run rate in processing, but we're only borrowing 100 million to do it. That's because of all that turnover. And then one of the really unique things, and it doesn't take a very complicated spreadsheet to see this, with our growth rates and our gross margin percentages, eventually you can drive enough cash into the business where, in theory, if you keep these sort of at the steady state, you don't need a line of credit. You can scale off the line of credit. I mean, I'm not saying it's the best decision, but that's attractive that you have the option to if you want to, which I think makes you very resilient in potentially a very bad economy, that you may not even have that much of a dependence on a line of credit at all. So I think that's one of the nice things. And then in terms of like just resilience in economic downturns, that's why we shoot for a 55 to 60% gross margin. Because the thing that's going to move the most in an economic recession, or a very bad one, let's say, is principal loss rate. No doubt about it. But we've got basically the 6% on dollars, on the GMV, 6% NTM or gross margin percentage. And that's a huge cushion for principal loss rates rising. We go from a 55% gross margin percentage down to a 35% in some sort of maelstrom, but we still have a 35% gross margin percentage. We've got a good barrier.
Charlie, you mentioned this. One of the beauties of the buy now, pay later history behind it was the advertising and the recruitment of dollars and clients was really on the retail side. It was really on the retailer at checkout, usually at checkout, sometimes on the product page, but you would see different options there. I mean, not always, but you might see one option there or not. With the subscription business, now you're starting to move into like, well, we're actually now recruiting customers. And so just talk a little bit about the mind shift and some of the approaches you're taking to customer acquisition costs. And I know you've spoken about lifetime value before, because that is again a different kind of cultural shift for the company.
Andy, absolutely. So we basically have two major user acquisition channels now. The original, which is our symbiotic relationship with the merchant, we help them make the sale. We create a customer there, and then the customer, we try to get them to download the app to learn more. That's our big initiative post sale with the consumer. But yeah, our lifetime values, and by the way, early days with this merchant only model, lifetime values were not strong. We could never go direct to consumer. We're like, we can't do this. It makes no sense. And I'll tell you like an example of why they were low. We had lower margin because with merchants, of course, they're businesses. They're trying to drive the price down, and I get it. So, we had like a blended 5% merchant MDR, and then you had user fees that made up like another couple percent. So you had like a 7% top line. And our cost of goods sold was 2% for processing, 2% for principal loss rate, and then 50 basis points to a basis point or 100 basis points for the cost of funds. So we had like a 2%, like $2 on 100 was our gross margin. And then we had lack of frequency, because how often are you going to go buy a pair of jeans a year? We weren't on the big retailers yet. So there was low frequency, low margin, low lifetime value. Then we invented premium, and then anywhere, and now on demand. And now those are high frequency products and also high margin products for us. You can see it because, the merchant model still exists, which is like that 7% top line. But our blended average top line last quarter is north of 11. So you know that these other products are higher than that. So now we have high lifetime value, or high margin, high frequency, great lifetime values. And so then we started thinking, wow, we can go direct to consumer. This is like, a realization last year. And so we started basically supplementing our merchant user acquisition with direct to consumer acquisition on channels. Like we do SEO, which is free. I mean, it's not free. We have to create landing pages, et cetera, but it's like casting nets across the internet, which works great. But we also are now advertising in app stores, in apps like Candy Crush, all these different places. And we're basically learning. I think we're going to get better and better at this over time. And what I think is going to happen over time is Sezzle, at least Sezzle, we'll see about buy now, pay later in general, but I think Sezzle leans more and more and more into basically becoming more of a product and marketing company, and maybe less of a sales and merchant oriented company. And I'm thinking like 5 to 10 years. This is not like an overnight activity, but I think as we keep on succeeding down this path, the initiative to the team is just get better at placing ads, get better at SEO, and we'll funnel more into that channel if it pays off. And it is.
And Charlie, are you seeing your competition make a similar move away from the retail platform to a premium type product? Is the competition kind of ramping up on that front?
I have not seen it, Rich. Not to a massive extent. We've seen some like dipping the toes in the water with it. If there was one company in the space that I'd say is the most similar, it's probably Zip. And there may be not shocking to some of the investors that have followed us over our time period. We almost combined with Zip because we probably have a bit of a like-mindedness. They have the on-demand product, and so they're probably the most like us in the space. Klarna has some elements that we have, but I think they still lean way more into the merchant side than we do. So we haven't seen it to any large extent yet.
Gotcha. And if I could just ask a quick follow-up on that, with regard to the merchants, which I know obviously was the focus, now it's kind of part of the focus, but with regard to the merchants, were you ever able to strike like exclusivity deals with them, or more often than not were you finding yourself with one or two other BNPLs in there?
Early days, absolutely. We had exclusivities. We had major retail exclusivities early days, and so did many of our competitors. But now it's turning into dual installs, triple installs. It almost looks like the credit card networks. You've got Amex, Discover, Visa, MasterCard. It's starting to turn into a bit of that.
Right. Okay.
What is the impact of AI on your business now? I see, the story headlines about Klarna. Perhaps you've seen these. They're not really
I've seen them,
hiring
yeah.
new people. They're kind of winding down employment in some ways and seeing that there's so many things that they can automate in their business. Is that true for you all at Sezzle? And how are you finding the AI talent, and where are you deploying them, and where do you see AI having the biggest impact going forward for you all?
You probably won't find me saying that we're going to get rid of people for AI, like like we see the competitors say, but I do believe in leaning into it. So we talk about it a lot in the company. Like, we've always been technologically inclined. My background is as a computer science. I was a developer. I was in computer science. I was tech oriented at my last company. I'm tech oriented here. I believe in product. I believe in tech. It's almost like our joke early on was like the Simpsons with monorail. It was automate. And that was before like the age of AI. So we were very much into automation. With AI, we are definitely leaning into it. But the mandate to the team is not remove your team members. It's make your team members more efficient, way more efficient. We're even talking about a project this year about, basically creating awards for the best implementations of AI across the company. Who can show us where they utilized AI and tripled their output or whatever it might be. Just the coolest implementations over the year. We want to see it, and there's going to be an award because we want to show it off in our town halls. Let's show to the team what people are doing in terms of utilizing AI. But there's some areas where we're of course using it. We were using a lot of AI with decisioning. It's an area that we've always been focused on machine learning, and bringing AI into that ecosystem, of course, makes sense. We are creating a center of excellence. Like we've just hired 4 ML AI experts to basically create like a center of excellence to help deploy AI across the company. Basically budget free for the groups that want to lean into them. You follow the incentives. So I'm trying to create incentives across the teams where if you can lean on this group, it's not against your budget. It's free. Lean on them and try to pull some AI into your group. Support is a great place to use it. With support, there's chat bots, etc. With our ad placement engines, like finding the most optimized ways to place ads, that's something we're looking at now. We've got shopping features and a product marketplace we're pulling into our app using AI to create even a shopping assistant. So we're trying to think about anywhere we can use it. And by the way, the other ones that's really neat right now is just the ability to have AI write code all by itself. I mean, we just had an internal engineering meeting where we were sharing this X.com post where some guy showed how he rebuilt Airbnb with Cursor. And so we were talking about that and like, this is amazing. So I think it's more about just making your team incredibly efficient, which also helps keep OpEx flat, which is one of the big goals of the company.
John, I'm really interested about the shopping and maybe the couponing opportunities. And I was thinking, does it start to compete with some of the retailers if people are shopping through the Sezzle, either platform or the app? And I'm just wondering how you think about that ecosystem evolving and just different opportunities tied to the really first party experience that you are developing with your shoppers and your individuals.
Yeah, so at the company we talk a lot about stakeholder management, which is related to B Corp. But we always talk about the most important stakeholder is the consumer. And so as we think about the consumer, our product, when the consumer thinks about BNPL and Sezzle, it's always related to shopping. I mean, that's how they learned about us. So they think about paying for with Sezzle related to shopping. And so we thought, what's like a natural thing we can bring into the ecosystem that makes sense for this customer? And we thought that it had to revolve around shopping. And that was basically creating like a Honey for mobile. Honey was dominant on desktop and laptops, but now as shopping has evolved into mobile, and for Sezzle, 90% of our shopping is on mobile. When you look at mobile, there's not like really a good Honey solution on mobile, like where it helps you find coupons or price comparisons, etc. And so our thought was, let's pull these types of features into our Sezzle app, and even in the future install a browser extension on the mobile phone of the customer through our app installation, to help that customer save more money. So you're thinking like our Sezzle customer, mid to low income, they think of Sezzle as a shopping tool. We're helping them right now with a little bit of budgeting financing, but if you can save them $15, they're going to Nordstrom, they save $15, they'll remember us, they'll love us even more. I mean, they love us already, we have great NPS scores, they'll love us even more. And then the other thing that I think it does is it potentially attracts adjacent customer groups. I mean, I think even the guys in the call, we use these types of tools. I mean, I could, when I say $15, I'm happy. It's like, guys make fun of me. Like, why do you care about it? But it's like, it just feels good to save money, right? But our core customer really needs it. Like, they need to save $15 if we can do it. But the groups just right next to them, they might also be interested in buy now, pay later. And so the idea is we built the best mousetrap in the space in BNPL, in our view. We've got every aspect of BNPL you'd want to have. We've got great margins. We've got the great lemonade stand. We want to tell the world about it. We want to get more eyeballs on it. We think that the shopping features are another way to do that. Because if you look at the companies in the shopping category, they tend to get a lot of eyeballs. If they have a detriment to that sector or that industry, they tend to have thinner margins. Well, we don't have thin margins. So we don't need to worry about the margin profile of that new product. We love that it makes us money if we design it right, but we really care more about drawing eyeballs into the business and into the app, and then also retaining the customer into our system so they don't forget about Sezzle. And here's an example I always give this is future vision. We don't have this built yet, but Sezzle will be installing a browser extension sometime in the future. When that let's say, Andy, we're chatting and you've got Sezzle on your phone, and I say, hey, check out this jacket. This great jacket, you're going skiing, I heard, I love it. I send it to you in a text message, right? Because that's how we normally would operate, text message or WhatsApp. You click on it, you open up your Safari browser, Sezzle's extension says, oh, Andy, you can buy this for $10 cheaper at this site. Click here. And now, I think you probably take advantage of it. I'm guessing you would. You may take advantage through Sezzle, but no matter what, you got reminded that Sezzle helped you. Sezzle helped you find a better price. You might go back into the app and you might say, oh, I'll check out with paying for again, because I got reminded. Where if we weren't doing this, you might have forgotten about us because you hadn't used this for 3 months. And, I forgot about Sezzle. Yeah, whatever it might be. And you dropped off as a customer. So we think it increases acquisition. It creates another product that has some level of profitability to it as well. But we also, I think more than anything, think it increases retention. And we've been good at acquisition in the past. We can get better at it, of course. We've had over 15 million people sign up. We got 2.7 million actives now, but we had 15 million people sign up. So you can see the problem, retention. Like I want to create products that keep those customers that have signed up stay in our ecosystem. And so that's we think a great adjacent product, helps the customer with a core need, makes them love us even more. But, of course, designing for ourselves, we think it draws more customers in and keeps them.
It's so great that we're only a little bit more than halfway through the interview and we've already learned so much. And now's the wild card moment, Charlie, where you get to say whatever you want to about anything, or you can ask us a question. You can tell us something unusual that nobody knows about Sezzle or about your past or present or anything that you'd like to share that isn't a response to a question of ours. And of course, you can say, I defer and pass, have Rich ask the next question.
Tom, I've got one because it was what you brought up earlier about credit cards. So first of all, you can't sign up for a credit card on a college campus anymore. That stopped with the Durbin Amendment, interestingly enough.
I wasn't aware of that. It's been a while.
Same for me. I signed up for a credit card on the college campus too, but they don't allow it anymore. But you nailed it with one of the concepts that credit card companies don't mind if you overspend. I think that's the dirty little secret, right? And I think that shows you, there's always this comment about, I think any new credit product, people are always wary. Is this good for customers? I don't think it's good. And the natural inclination is bad for customers, right? But I always tell people, think about a holiday season, how Sezzle approaches it versus how a credit card company approaches it. With Sezzle, I'm not kidding, we batten down the hatches. We don't want customers to overspend, which they're likely to do in the holiday season. Mm-hmm. The reason we're not wanting them overspending is because we're 100% aligned with repayment. If a customer fails to repay us because they overspent, we lose them as a customer. We don't want to lose them. So we lower limits in some cases. We don't allow new customers to join, et cetera. Credit card companies, I think it's the flip. I think credit card companies, people overspend in the holiday period. That creates a revolver. And now that revolver, that customer has the high lifetime value. It's the flip. And so I think if you think about that scenario of overspending, who's trying to stop it, who's okay with it, I think that tells you which one is the better product for the consumer, which I think is an important story.
And the consumers seem to have spoken with their actions, given the fact that you just turned out a great fourth quarter announced earlier this week, and you had basically a doubling of sales on the back of a holiday surge. So they seem to be, drawn to the product for that very reason I think that you just laid out.
Exactly, Rich. I think it feels safer for them. And it doesn't just feel safer, it is, because they're not building up a balance that they can't service.
And no,
Rich,
go
I
ahead.
was just gonna quick jump in with, and
Yeah.
Charlie, the repeat purchases, I was actually very impressed. I think it was something north of 70, maybe on a course over over the course of a year. But there's a lot of repeat activity going through the Sezzle lab, which was really impressive and surprised me.
Yeah, I think the key reason there is the new products, subscription products and on demand, because now that card, our Sezzle card, can become top of wallet. We've even designed, like, here's a unique element of the Sezzle card. We don't want to finance, things under $50. And some people will try. We don't like it. But if you finance like a low dollar purchase, so let's say you put Sezzle card top of wallet in your Apple Pay, you can tap, because if it's a low dollar purchase, we'll just do pay now. It's pay in full. So the customer doesn't have to think. They like to use this so much with pay in four, they can just tap. If it's like Starbucks, it's just going to pay in full. But if they go to Target and tap again, because we're top of wallet, $120 purchase, it's 3 payments or 4 payments to 30. So we've done things to help the customer keep us top of wallet. And I think with subscription, you're kind of top of wallet anyway, in a way. So I think that's really helped the frequency numbers.
Sorry, Rich, go right ahead.
Okay. I was just going to say, going back to, when you were addressing the performance of the fourth quarter, there was talk about gross merchandise value and, terrific performance on that front. A lot of speculation that you're going to cross into $1 trillion for the industry sometime in the next year or two, maybe 3 years. What are the risks to that growth? I mean, I'm assuming just, economy, regulation, et cetera, but I'm just kind of curious what your take is.
Well, I think one risk you could say is, if it's that attractive, is competitive risk. But this sector already went through a pretty wild competitive phase. If people have followed the industry, everyone was diving in. A lot of companies didn't make it. Apple even dove in and then pulled back 6 months later. So I kind of feel like, and people say like, oh, there's low barrier to entries. I'm like, here's the keys. Try to start your own. I'd love to see your low barrier to entry. There is a decent barrier to entry into this space because there's some network effects. New customer cohorts have higher loss rates. So if you're starting from scratch, you're going to eat a lot of losses early on. So there's some of that as well. So I feel like we've, built out the competitive space and we've got a nice cohort of competitors. But if you keep on growing at attractive rates, yeah, maybe the credit card companies start to launch competitive products. Maybe some other banks launch competitive products. So there could be more of that, I think. Of course, regulation. We've had a downturn now because of the new administration, but administrations change. And so 4 years from now, if the administration becomes more regulation focused and it becomes more, near that trillion or over that $1 trillion mark, regulation could become a little maybe overweight at that point. That's probably, in my view, the main items. And of course, economic risk. But one thing I'll say about this customer, and our CFO says it because she's been in the lending space for quite some time, we've got a young subprime customer. And younger subprime customers, her saying was, these customers are already in a bit of a recession. A lot of these customers are paycheck to paycheck already, and they're blue collar, gig economy, looking for jobs. I think recessions honestly hit the group here, or the listeners to the Motley Fool, more than they hit the blue collar group in America. And so I think there could be like some sort of impact in terms of economic impact if it becomes a big portion of the economy. So that could be another one.
Got it. And if I could just follow up on that, because you touched on it. You mentioned, the credit cards. Have any of the major credit cards looked into their own entrant in this space, their own, BNPL?
They've done a little bit of it post-purchase. So what we've seen from some of the players, I think Chase has done this. And Amex, I think, was the first to do it. But they're not really the same customer profile as us, but they've been doing a little bit of this. You make a purchase for $200 on your credit card or debit card. In some of the apps, you can post-purchase split it in 4. I'm not sure what the economics look like for some of these banks when they do that, if they're charging a fee to the customer, because at some point to do that, they're going to have to charge a fee of some kind to make it a profitable venture. But that's kind of what they've done, is post-purchase splits of payments.
I mentioned earlier you're a B Corp, but for now I want to focus a little bit on the shareholder. journey as a stakeholder in your business. You're in a unique situation as a public company, as the founder CEO, owning 40% plus of the shares. We love to see that at the Motley Fool. Of course, sometimes historically, very high insider ownership, and I know this is not happening at Sezzle, so I shouldn't even bring it up, but people start treating that company as their own piggy bank. There's like small, obscure company with large insider ownership. For us, we see high amount of skin in the game for somebody who's built a business and held on to their equity throughout. I'm also just wondering for your thinking as an investor, when you see, I first recommended Sezzle in a special report of the Fool in July in the low 80s. Then it went to 477. And the stock is so volatile. How do employees think about that as a measuring stick and what's happening? And how do you think about it? And I hate to tag another question to this whole stakeholder group, but also how do you think about attracting institutional shareholders? There are some investors who look at small businesses and look for validation of institutions that have a great track record being a shareholder of that company. Does that matter to you at all? So how do you put all of that together in your thoughts as a shareholder, and how you would speak to shareholders of Sezzle, and how to address volatility in a stock like this in their portfolio?
Well, great questions, Tom. I think, with insider ownership, first of all, I hope people see that I'm not treating this like it's my own car, to drive for, but I definitely care. I definitely care about things, and I definitely look through the lens of being a shareholder as we build this company. And I think that led to a lot of our tough decisions when we, if people have not followed our history, I'd actually recommend you go back like 4 or 5 years. We were an ASX listed company, Australian Stock Exchange, and then we direct listed NASDAQ, but we've got 6 years of history of reports. So I think it'd be worthwhile to, especially go back to like probably 2022. We were burning 70 million. We missed a fundraising window because we were trying to go public in the United States. We couldn't get through the SEC process, and then techpocalypse hit. And then we really had this like come to Jesus moment. We got to make money. Like, because I'm old enough, I'm 48 years old. And I was old enough to be a young investor during .com. And if you go back and look at .com, if you didn't get to profitability, you were dead. It was 4 years down, and then 10 years to get peak to peak. And so we were talking about that. We're like, we just got to we got to make this a profitable company. We had to do it. So we made really, really tough decisions. To give you an idea of like, and by the way, I'm not proud of these things, but we had to do the things we had to do. We cut international expansion. We stopped Europe. We stopped India. We stopped Brazil. They were going to be burners for a long time. We went from 580 employees to 240. A lot of that was the international expansion cuts, but we also had to do a 10% cut internally. So we are willing to do the things that are very difficult. And I've watched other companies. I don't think they're as willing to do it. We knew we had to do the things, and I think that's where the heavy internal ownership comes into play. Those are not fun decisions, but we knew that it was better to pull the Band-Aid and then build up. And we even did things like cut off deals with really attractive, I can't name the names, but really attractive enterprise merchants that would have really dazzled people. We said, no, we're not going to do this deal right now because we have to do all the right things to get to profitability. And that led for us going from -70 in net income to -35 to 7. And then this year, around 70 for 2024. So we really made a great turnaround. And so when we think about, and I've learned a lot of lessons along the way. I've always been like the startup guy, the money burner. And so I've had to learn a lot in this process, but I was an investor as well. And so I was talking to our team internally, we're like, we got to make money. We got to have good gross margin. And so we started to have this mindset, and we started to have the mindset in town halls with the team. This is what we've got to do. And to give people an idea of how much people doubted us. So we got to profitability on the Australian Stock Exchange, making 7 million a couple years ago. And we decided we wanted to direct list. We wanted to get listed in the United States because we're profitable now. We direct listed in August of 2023. Our market cap got down to 38 million. We were a 38 million market cap, making 7 million net income. And we had investment bankers telling us, you guys should issue stock to create volume. And I'm like, over my dead body, are we issuing stock at this at this market cap? No way are we doing that. I gave one of the analogies to the investment banker. I was like, I'm guessing your house is worth $1 million. What if I told you I'd come up and buy it for $50,000? What would you do to me? You'd probably want to punch me in the face. That's basically what you're asking me to do right now. We're not going to do that, So anyway, so we had this ideology, and Lee Brading, our head of IR, he's the one that, he's not unique, he didn't invent it, but we had the field of dreams kind of ideology. Eventually, if you build it, they will come. And so our viewpoint was keep on doing the right things, keep on growing the business, keep on building a great product. Eventually, you'll get the respect. And so what we did to get institutions on board, by the way, is very difficult because when you're a 38 million market cap, investment banks don't really care that much about you either. So I don't know how we scrounged our way into some of these investor conferences, but I still remember our first investor conference we went to with KBW, and we only had one meeting. We were in New York, we had one meeting that day. And that was a couple of, year and a half ago. And, we just did one yesterday with Oppenheimer. And I had to go get a couple of drinks and a steak afterwards because I was so damn tired. So we've done, I think, a decent job in terms of changing that. And the Field of Dreams approach worked. Basically, we didn't dilute. We didn't do an issuance that we thought was irresponsible. We just kept on building a better and better profitable growth company. And it started to attract the eyeballs, and we started to attract the respect. And that's been our viewpoint, is we were just going to do the right things. I'm a fan of Charlie Munger, Warren Buffett, Elon Musk as well, Jeff Bezos. I have a gamut of people that I kind of look to and respect. And, I think the Charlie Munger, Warren Buffett side kind of popped out for us. Just, short term, it's a voting machine. Long term, the markets are a weighing machine. And we're going to play the weighing machine. We're going to keep on doing the right thing. And that's basically what we did. And it worked out.
That's awesome. We love to hear that, Charlie, because that's very much the way that we think about it as small business owners ourselves into the Motley Fool, many of us. Charlie, I did want to talk about the advantages of being outside of Silicon Valley as a tech forward thinking company, finance company, but tech forward thinking. You're in Minnesota. I don't know how many employees you have locally versus globally versus around the world. How do you think about culture, balancing in office, not in office? Some thoughts on there as a small business, as a business owner yourself.
Yeah, really interesting question. It'd probably be a long answer, but when you build a company, my first company I built in Charlotte, North Carolina, called Passport. We were a mobile payments for parking business, and then that was a non-tech center. We did it and did it successfully. Then Minneapolis, the same thing. And we had a lot of the early venture capital investors were like, how are you possibly going to build that company in Minneapolis? It's so conceited, honestly, that only the smart people live in San Francisco, apparently, or New York. It's like, no way. If you have smart people coming together to build something, you're going to probably build something pretty dynamic. It did make fundraising a little bit tougher, no doubt about it. But I think that also makes you more, creates a mindset towards building a really good company earlier. Because if you got, we had 1.8 million in seed money in 2016, which is good for Minneapolis, actually. But some of these companies are getting 20, $30 million in seed, in some of these peak areas. And it just creates stupidity, honestly, which is hard to get yourself out of. And so we were always very miserly. We were spending $50,000 a month or burning $50,000 a month back then. And that, miserly attitude helped us adapt when we had the wrong business model out of the gate. And I think that miserly, people even know me, I'm not a big spender. Let's just say that. Maybe it's because of the, attitude. You guys are founders, so I think you have the same kind of attitude probably. But I'm not a big spender, and I think that kind of carries over into the company. And, with Minneapolis, you've got tons of smart people. And what's really interesting about your next part of your question, though, about the office culture, early on, I was a big believer that you had to be in the office. Huge believer. Everyone's got to be in the office. It's culture. It's how we compete. It's how we do things. And then COVID hit, and then everyone started working remotely. And we had people starting to move, and we're like, yeah, it's fine if you move. I get it, And we kind of viewed it as the Humpty Dumpty moment. Humpty Dumpty fell off the wall. People started working remotely. We're not going to pull people back. I didn't feel like that was right. And we didn't want to lose good people. So we said, it's working. We're actually more productive. And if you think about it logically, if you do a good job with this, you're basically getting rid of the commutes, right? So it's hour commute each way, maybe. Yeah. And so you have 2 hours to share with that person. And what we found is they're giving us an extra hour, and they're getting their personal life an extra hour. And I viewed it as a win-win. And I think the companies that are forcing back into office are just probably really horrible at performance management and monitoring if people are actually getting things done. I think that's really the truth of it. They're just bad at it, and they think bringing people back in the office is going to solve it. I don't think so. I think you just have to have really good performance management, ask a lot of your team, challenge them, which by the way, is the win-win. People don't realize this. Challenging people is what they want. People don't want to be bored. They want to be challenged. Please get this thing done. I know it's going to stretch you a little bit. By the way, we're not talking about making people work over weekends all the time. It's just giving you a challenging project where it takes a bit of your effort, a lot of effort. And if you do that, I think you tend to find great results. And we found excellence through being remote. And that's also helped us, the companies that lean into like the Silicon Valley in New York, honestly, early on, I wouldn't even look at resumes from California and New York. And we don't even do it that much anymore because it's like, you just get trapped in this. I got to hire this person and they're super expensive. So we just delete those resumes, quite frankly. And, what's also happened for us too, is we've started to offshore a good deal in South America. So we've got our headquarters still in Minneapolis, but it's more like a meeting space for us now. We still have like 100 employees in Minneapolis, but we have people everywhere across the US. And then what we started to say was, if we got people working remotely, let's look at offshoring in South America. And so we started to offshore there because you can hire people in Colombia that are incredibly intelligent, did a great job in school as well, and speak English, maybe with an accent, but who cares? And we've been doing a bit of that too. And so now we've got a pretty diversified workforce with 160 employees in Colombia now. So of the 400 employees, we've got 160 in Colombia and South America. And that's helped us keep our OpEx lower as well. And then when we tell the team, there's always this worry about the US team is like, oh, we're going to do a layoff. And I always say this. I am looking out for the Sezzle team. If you're on the Sezzle team and you're doing a good job, you're not going to get let go because we found someone that can do your job cheaper. No way in hell. If you do a great job, you're just going to get rained on. Actually, we're going to reward you and give you raises. What we're trying to do is we're trying to make it easier to keep on rewarding you and give you great benefits by reducing the cost structure across the company so we can treat every Sezzle employee great no matter where you're located and do it for a longer and longer period of time. And by helping us reduce our OpEx exposure, we can keep on rewarding people everywhere in the company. That's why we do it. And you have to maintain that social contract with your team. You can't, the companies that do layoffs, they blow my mind. Doing a layoff because you're going to hire someone in a cheaper area, I think that's such a huge mistake. Your social contract with your team is gone. And so we really enforce that, and I think the team has seen it. That we do what we say and say what we do.
Yeah. Charlie, you touched on a few minutes ago, you touched on the need to, kind of pull back from geographic expansion just, because you guys were ramping up. Are you rethinking that now? And if you are, what regions, kind of do you have your eye on? And also, is your competition aggressive internationally?
We really aren't changing the mindset, Rich. I think
okay.
What I realize is it's very difficult to expand internationally, especially in financial services, because of all the rules and regulations. And, United States is still pretty relatively deregulated versus other areas of the world. So I think that also helps us. And what we realized is the US market is huge. And so what we'd rather do, and we're in Canada as well. What we'd rather do is we'd rather expand horizontally in our product offerings in the United States. It's just such a huge market, and in Canada, I should say. This area is such a huge market, and you can build such a big company. Our view is just let's keep on focusing on this area unless something pops up. And I always say never say never. I'll never say never, but right now, focus on U.S. and Canada.
Gotcha. Okay.
Close with the Dreamweaver question. The company's market cap is about 1.7 billion. I don't know how far out you want to imagine that this has happened, but let's imagine that you have achieved our Motley Fool dream as shareholders, and it's a 10x from here. I would like you to share with us in closing what has been fulfilled likely in your broader mission beyond the stock price by achieving a 10x result from here. So market cap is now 17 billion. What is Sezzle doing in the world because of that commercial success that makes you proud?
Well, I think, what you'll probably, how we'll look, first of all, we'll probably look like a company that's on a lot of merchant checkouts. We'll be a shopping app that's top notch, that customers want to reach out to help them with their daily lives. I think we'll also have a lot of financial services type of inclination in the app as well. Those are our big two pillars, financial services and shopping. And I think we'll be just a massively impactful product for, I think, still mid to low income customers. Younger mid to low income customers will be the core, and will be a go-to app for them, an app that they just have to have on their phone and they have to have a Sezzle account because we help them with amazing deals and discounts on shopping and just being a great shopping app. And then we also have financial services features beyond buy now, pay later that are just helping them in their daily lives. I think that's the way for us to achieve that 10x vision. We just have to become the go-to.
Charlie, thank you so much for this hour. We've really enjoyed learning about Sezzle through our own research and recommending the company to our members. We have a lot of members that are shareholders of Sezzle, and this hour really helps us understand you, your perspective, your company, the mission, and the priorities of the business so well. So thank you very much for this. Hopefully we can get back together in future and have more conversations like this, but this was just a fantastic hour, and thank you so much for being here with us.
Thanks for having me. Again, I'm a huge fan for a long time. It's exciting for me to even be a part of this. I really appreciate it, guys.